Good morning, everybody. Welcome back to another episode of The Market Open. We are live. It is a Wednesday, July 29th, and we have quite the day that we have ahead of us here with the FOMC. That's going to be coming up in about 4 hours. We're going to see what happens with Kevin Warsh's second FOMC. On top of that, you've obviously got Meta, Microsoft, Robinhood. Got the green hoodie this morning. Let's see if it changes any of the market action in the pre-market. But not only do you have all those earnings that we're going to be looking at after the bell, obviously two of the biggest hyperscalers that we'll be talking about, FOMC, you've also had, and I didn't even know this, to be honest. I mean, I realized this after the bell yesterday. SK Hynix that reported yesterday. I did not know we had one of the largest memory companies reporting yesterday, but they did report. The report was good, but they did miss on a few metrics, which in this market environment, it's just not the environment to be missing on earnings. And as a result of that, it obviously had implications for South Korea, which is causing a bunch of implications for the broader memory trade. Kospi, the South Korean index, was down another 6% last night, which is just not something that is pretty to see after going down 10% the day before. We also had SoFi earnings this morning. We will talk about SoFi. Unfortunately, that stock is also down in the pre-market. I think right now, any company reporting earnings is just in a tough spot in this macro. I mean, there's a lot to analyze and dive deep into. And yesterday, we spent a good amount of time exploring every different bear case that the market was kind of struggling with, whether it was NVIDIA backstopping stuff or whether it was the Iran-US geopolitical conflict getting worse, which, by the way, there was some potential ceasefire that was up in the air yesterday. That is out the window as Iran attacked last night. And the U.S. is getting ready to attack today, and oil is once again spiking up 6% in the pre-market. So, I mean, just everywhere you look, there's not really positive catalysts or good news, which is hard to digest. But nonetheless, if the market's going to have to digest it, obviously the market's going to be a bit more upset than not, and it's going to take it out on many of these names. Having said that, a lot of these names have gone down a lot over the past few weeks. And so I think everyone's trying to figure out where is that bottom? Is that bottom finding a way to come through? SoFi right here in the pre-market down about 5.5%, which feels a little aggressive, but we'll talk about kind of what the street might not be happy about. And everything else in the pre-market continues to be red. NVIDIA is red, Tesla's red, ASML is red, SanDisk is red, Micron hit 770 last night. 818 right there in the pre-market. It did recover up to 850 last night, but then the market kind of digested the SK Hynix earnings and once again, was not the happiest about it. CoreWeave's down, Amcor's down. So, things are down in the pre-market. They're not as down as they were last night. They're not as down as they were yesterday pre-market. So maybe there's a little bit of a change, but I think the entire market is going to be on tilt until we get FOMC at 2:30 p.m. Eastern. VRT is dumping again. No matter how good of an earnings that you put up in this macro environment, it's just really tough to get the market to be on your side. VRT right there down 9%. Bloom Energy had a phenomenal earnings. That's up 9%. It was up a lot more than 9%. So hopefully that can hold on to it. And that goes to show you how good the earnings were for the market to actually give it some love in the midst of this macro. But with FOMC in a few hours, I think everyone's going to be waiting to see what Kevin Warsh ultimately says. All right, let's get into it. Good morning, good morning, good morning. Thank you for being here. June, Charles, Lady D7, what's up? Rachel, thank you for being here. Marie, good morning, good morning. Rohan, Krupa, Martin, thank you all for being here. Some people are saying Schwab is down. Yesterday, Hood was down. So weird if Schwab is down today, but I think that means that a lot of people are opening up their brokerage and the traffic is increasing, probably for the wrong reasons because people are more, scared and likely selling. But if Schwab is down, then that probably just means there's a lot more activity going on in these brokerages. Arthur, what's up? Good morning. Sai, Zam, Vest in the Future, Zocold, Yolan. Thank you all for being here. This is going to be a long, long day. I will be gone at 11:30 after the market open. I'll be back at 2:15 for Warsh. And then I'm going to be streaming the FOMC through a WeWork because I'm going to be in New York. Robinhood is going to be having their Q2 earnings in person this time. So in New York, they did the last 2 times in California. So I'll be at their earnings at 5 p.m. So the stream will be still on the channel. I'll still be with Tanner and Roy. I'll just be gone starting at like 4:45. So Tanner and Roy will still be streaming the call itself. And if I ask a question, you guys will see me in person on the call. But it's going to be a long day. We'll have a lot to talk about, a lot to get into. And obviously Meta and Microsoft are going to be super important because Google was not enough to get the street to be excited with their CapEx. So Microsoft and Meta are going to be important. We're not going to be listening to Meta and Microsoft. We'll obviously cover the numbers. Jose and Neil will be listening to Meta. So we will be listening to Hood because Hood is, the stock that Roy, Tanner, and I cover the most. But obviously, we'll have a lot to dissect and analyze when it comes to Meta and Microsoft itself. Charles, what's up? Hubbers, Paul, thank you for being here. KK, Bionic, Estefan, Diana, not really retired. That's a great name. Diana, not really retired. Thank you for being here. Brandon, Gene, Jason, Nick, Channing, Otis, Charles, Robert, Musil. All right, let's get into it. Let's start with SoFi. Now, to be honest, I haven't gone through every little internal nuance in their numbers. Obviously, Tanner and Steve will be much better than that since they understand this company better than myself. But just looking at the headline numbers, it's a good quarter. Revenue's up 40% year over year. Net income, $157 million. Adjusted EBITDA up 44% year over year, $358 million. Total loan originations, $14.8 billion. That's a new record. Members up 35% year over year, 15.8 million records. That had more than 1 million in the last 90 days. And products up 24 or 42% year over year, 24.4 million. Noto, 2026 is shaping up to be a defining year, and our second quarter results mark a clear inflection point for SoFi. Despite continued market uncertainty, our business model continues to prove its durability. For the first time, we added twice as many products as members, a major milestone that underscores the trust that people place in SoFi. On top of that, what was also really important about what SoFi did is that they now are assuming a full year tax rate of 22%, which I believe is higher than what they originally assumed. But they raised their guidance to 4.85 billion, up from 4.655 billion. So this is a company that fundamentally every single time is able to raise guidance, beat expectations in the midst of headwinds, whether it's no rate cuts, whether it's increasing tax rates. And their EPS guide now still assumes 60 cents. If you put a 40, 50 multiple on that, which is currently what SoFi ends up getting, or what SoFi theoretically should be getting based on their growth, stock price is $35, right? So I think in the midst of the sell-off right here that we're seeing, you look at the numbers, you look at the multiple that should be on the stock, and you look at the growth rate that they're putting up, and it obviously looks undervalued. Now that begs the question, why is the stock down? Honestly, I don't really know. The only theory I've heard is that the guidance could have been a little bit better. And the monetization of the members could have been stronger than the member growth itself, which was some of the questions that were asked on the call. I mean, now, again, you could say that for any company. Guidance could have been a little bit better, although they did indeed raise guidance. But at its core, I did not see an intrinsic red flag to be worried about. There's nothing that's slowed down, nothing that's slowed down sequentially, nothing that needs to sort of be a check in the box when it comes to the loan originations, which again hit a record. I mean, the biggest thing the street is worried about is that if we end up getting rate hikes, will SoFi be able to originate loans? And in the midst of not getting a rate cut, SoFi is originating loans. Also, SoFi is not assuming 2 rate cuts anymore. So a lot of this guidance that they gave back in early 2026 was based on the idea of 2 rate cuts. I don't even know if we're going to get 1 rate cut. Quite frankly, today, it's going to be a mystery if we end up getting a rate hike, which would be unbelievable if we get it. There's still a 35% chance that it does happen. But if we do, and SoFi still keeps their guidance, that means they're ready to, be constructive in a world in which we could still hike rates and not cut rates. So I think the reason the stock really is down is because the potential of that 35.8% chance being true today and us getting a rate hike would obviously make it very hard for rate-sensitive names like a SoFi to do well. Theoretically, I think they would still do very well in that environment, but obviously the market disagrees, and that's why the stock is down 5%. I also think the stock's down 5% because honestly, in this macro, any quarter that is missing a little bit of juice here and there in terms of what the street wants to see, their stock ends up getting it. We saw it really with the semi names, TSM, ASML, air test systems. Like you get a little bit of a pop and then you fade all of it because even if your earnings are good, this macro is just being very, very upset essentially at names that aren't really corresponding with the expectations they want. Bloom Energy getting some love right here. Hopefully that one can stick. But I think the broader problem, and this is, affects Meta, Microsoft, Robinhood, and Google, which had incredible earnings as well. Like Google grew 82% year over year and the market took it down 7%. So it does worry me for Robinhood. I think they could have a really good, I think this is going to be their best quarter they've ever had in history because of how strong Q2 was on trading volumes, but I don't know if that's going to be respected. This is SoFi's best quarter in history. Obviously not being respected right now. SoFi, again, a little bit more rate sensitive than Robinhood, but this macro is ugly. And a bunch of different headlines happened this morning to continue to prove that this macro is ugly that we'll get into. But I think that ultimately is affecting SoFi. Before we talk about South Korea and some of the updates that we had right there, let's talk about Vertiv. So this is liquid cooling for data centers. It's down 8.74%. Vertiv, again, in this environment, you can't miss, which is unfortunately what SK Hynix did last night. Vertiv actually missed on one of their metrics. So they missed on revenue. It's a relatively small miss, 3.27 billion versus 3.38. So they missed by 3%. EPS, they beat by 6%, 152 versus 143. EPS is still up 60% year over year. Revenue is up 24% year over year. I think there's something deeper for why the street is upset about this. My gut tells me that if the data center trade is being questioned, then obviously the liquid cooling technology that gets put into data centers is also getting questioned. And as a result of that, you have a broader argument around why the stock could be taking a hit as the street tries to front run that. Now, the Bloomberg headline is that the reason the stock is down is because the company reported second quarter net sales and organic sales growth below the consensus estimate, aka they simply missed on their consensus numbers. It's just in this environment when data centers are like the most important thing in the world, but they're also being questioned more than anything in the world, especially when the entire AI trade is levered towards the idea of building out data centers. If you're missing, whether it's memory companies, whether it's photonics companies, whether it's liquid cooling technology, if you're missing those expectations, like again, imagine if TSM and ASML missed. They beat, fantastically, but imagine if they missed. If they actually missed, I don't even know what would happen to those stocks. So the fact that Vertiv, SK Hynix are missing, it's just not something you want to see. Now, are the misses that relevant? No. Like missing by 30, 40 million right there in the context of SK Hynix, a couple billion, which again, it's not really that much given the type of growth that they're putting up, 250% year over year on revenue and 550% on EPS. But still, it's not a good headline, especially in the ugly macro that we have. And that is why I think Vertiv is still getting hit right here. So, I mean, I think nothing in the earnings would stop this company from continuing to execute at the level they're executing at, especially if the data center build out continues to be as extreme as it is. And Meta and Microsoft will probably confirm that today. The stock is still up 50% year to date, which is one of the things I think it's hard for a lot of people to stomach, that many of these names that are in the drawdown that they are experiencing are still up so much when you zoom out. It's just the majority of buying happened near the top, which is why it's so painful. But, many of these names have still done incredibly well over the past 12 months. So let's get into SK Hynix and what happened there, because that also was an issue. Vertiv also did raise guidance. That is correct. They did indeed raise guidance. It's just that headline miss. That's like, you can't do it. And this is what happened with SK Hynix last night. Me and Jason were live on Technical Tuesday when this news came out, and the memory stocks like immediately tanked, like 7-8% down on Micron after hours type of tank. They're not as bad as they were then, but I mean, you can't go public in the US markets, say you're 7x oversubscribed, make such a big deal that you're the greatest South Korean company in the world. And then, US tech companies, they try not to miss on their earnings. Like, I don't know what happens in South Korea, but in the United States, a miss on your earnings is actually bad. It's not the worst thing in the world, but you try your hardest. This is why the sell side are treated so well by C-suites, and they go out to wine and dine and all this stuff, because you want to make sure the analyst estimates are consistent with the numbers that you're putting up, so that when the headline results hit the tape, you don't miss, especially not the first quarter after you go public, and SK Hynix missed. So they missed 54.6 billion versus 57.7. That was missed on revenue. Operating profit, 41.6 billion versus 44.2. Again, operating profit still up 5x year over year, revenue up 2.5x year over year. So it's not like the numbers are bad. It's just in the context of what the market wanted, they weren't the best. And then as a result, Kospi, which opened up 1.5% up on the day last night, ended up closing down 6%. Now, there's a couple of nuances to kind of what's happening here around SK Hynix and why the market has been a little bit concerned about what's going on. And I think it primarily has to do, this is the take that I saw this morning that I thought also makes sense, around HBM and DRAM pricing. So this I thought made a lot of sense. It takes 3 DRAM wafers to make 1 equivalent HBM wafer, kind of like how in Minecraft you need 3 bushels of wheat to make 1 loaf of bread. The HBM demand thus eats commodity DRAM supply and drives the price up. That's why SK was comfortable adding DRAM capacity, because worst case, they converted to HBM. Also, I think the analysts had the pricing mix between HBM and DRAM, which is why when the actual numbers came out, the numbers were a little bit lower than expected, because again, the analysts thought that there would be a different pricing mix when actually putting in their numbers. This dynamic has been well known for a while and has been why for the longest time people have been in memory, and the math works out beautifully. But what some people missed is that there is one flaw. Because all else being equal, more HBM per accelerator actually means less DRAM demand, despite the cannibalization dynamics to make HBM. Everyone would prefer more HBM on each chip if they could, and all roadmaps point to that. H100s are shipped with 80 GB of HBM, B200, 140 GB, and Rubin is ramping with 288 GB. Those extra HBM bits come out of DRAM's share of bits. The reason is pretty simple. We aren't using DDR because we want to use it because we have to. Ask any engineer if they could put 1 TB of HBM on every accelerator. They would rather do that than spec more servers per DDR. What's very interesting about this is that's essentially what happened with the SK Hynix earnings. The analysts assumed more DRAM versus HBM, which is why the pricing got mixed up. And as a result, they assumed a couple extra $1 billion in operating profit versus revenue. And that led to a miss. And again, if that continues to be the case, it goes back to the Bernstein argument that we read last night from the sell-side report, which was, hey, we think these prices are peaking. And if these prices are peaking, which is, again, I don't think anyone knows if the prices are peaking, but if the prices are peaking, forget about supply. Obviously, we're still supply constrained. If the prices themselves are peaking, meaning even if we're still supply constrained, there's no way we can continue to raise prices, that points to the trajectory or sustainability of that growth. And then on top of that, what happened when the Kospi hit a circuit breaker last night, South Korea is now hosting an emergency meeting regarding the stock market crash. It's down 40% in the past month. I mean, imagine if the S&P 500 was down 40% in a month. The meeting can lead to a ban on short selling and local pension funds forced to buy shares, which would be kind of crazy. I mean, imagine if the American market said, hey, we are not letting people buy shorts anymore or sell short stocks anymore. And imagine if we're going to force pension funds to buy shares of American companies to stop the selling. Like, it's kind of incredible when you really think about what's happening right here. Once again, this entire country is propped up by two companies. Those two companies are selling fundamentally a commodity that is in high demand, a commodity that will continue to be in high demand. But the sustainability of the growth of that commodity and the earnings of that commodity continue to be in question. And when you miss on your numbers based on expectations and based on all the internal nuances between DRAM and HBM, which, by the way, are changing every day. I mean, the overall demand for memory is only increasing, but the internal nuances between the companies that are producing this stuff, the fabs that are coming in line, the innovation that's happening in the private markets, the incentives aligned with all the hyperscalers to reduce their CapEx spend on memory, which means they have their own internal biases, and then ultimately the oligopolies that are fighting with each other to try to get as much market share as they can. That is what goes into the pricing of these stocks, along with the leverage. That is like the biggest thing that's happening versus just the broad story that AI needs memory. It's like, yes, AI needs memory. No one's saying it doesn't, but there's so much nuance to that story that I think the market is just tired of and exhausted, quite frankly, of that nuance because it's a lot to factor in. And because it's a lot to factor in, you're seeing the market react in a more negative way. I mean, I did not expect Kospi after SK Hynix had relatively strong earnings, even though they missed on a couple of different metrics, to actually go down 6%. What that means is maybe there were more margin liquidations, but also there might be some people that are just like, I'm out. Like, I've made enough money year to date. It's still up 31%. At one point, it was up 100%. So obviously, it's taken a pretty big hit. And I want to take my money and run because I've obviously done very well, which only corresponds the compounding of selling, which then begs the question, what does it take to get Kospi back up to 9,000? On the way up, it feels exciting. On the way down, it feels painful to go from down to up in a V shape that actually recovers all of those losses. You just need that level of euphoria and excitement again. And then the worst part about what's happening right now in the memory trade is that every earnings that has come out, whether it's for the hyperscalers or for the CapEx beneficiaries, has been really good, with the exception of a few that missed on very small metrics. And the market didn't care. So if you think, what brings euphoria back to the market? What brings excitement back to the market? What gets people to take out a loan to buy these stocks because, they think they're going up and they need to get into these names, which creates all that momentum? Theoretically, it's usually earnings. It's usually a company that produces such good results that everyone's like, wow, I have to be in this. And that creates the FOMO that then compounds. If the earnings are not creating that level of excitement, it begs the question, what is going to create that excitement? If Jensen signing a $500 billion deal with SK Hynix, which he signed for the weekend, is not going to create that level of excitement, then, I mean, what does? Not to say the investment can't still do well, and not to say it has to go zero by any sense of the imagination, but what gets it to those levels that it was at before that got people interested? By the way, the entire Kospi move from late April into early June has now been erased in the past month. So, the historic move for the index, which is still historic because it's still up 40% year to date, has been gone in the past month. It's almost like it didn't even happen. It was kind of like you had to sell at the top or at least sell on the way down and, take whatever profits you could. Otherwise, if you bought a few months ago, you're relatively flat. when it comes to what is happening with costing. And that's why Micron, Sandisk went below 1,000 last night, by the way, as that one has been taking a hit. And, Micron fell below 800 last night. So today I'm going to be really curious to see, have we found somewhat of a footing on a bottom for the memory trade? Because at least now all the results are out there and the market can't be scared of results that are bad. You put out the results, they weren't the best, but they were still pretty damn good in the context of SK Hynix. And due to that pricing mix between HBM and DRAM that the analysts kind of mixed up on, and also that potentially given that analysis around what it means for HBM per accelerators to increase versus DRAM per accelerators and the implication on peak pricing, which is what Bernstein was talking about yesterday. You put all that together, it's at least out there in the ether. And so now maybe the market can move on from that. And I would kind of be surprised if the market gaps down memory today, given all the news is there. And I feel like it's relatively baked in. But if it does, it just goes to show that this is a trade that is in jeopardy right now, primarily based on leverage, but also based on the fundamentals of the trajectory and sustainability of its growth. And long term, we're going to see how the market ultimately thinks of it. Obviously, macro headwinds have also been a broader issue, and we'll talk about what's going on with Iran and Trump in a minute. But the macro headwinds only exacerbate the leverage that is in the high beta names, and the highest beta of the highest beta names are memory. I also think the last thing to say on memory, it's going to be really important to see if Nvidia falls down with the memory names. Nvidia has been kind of holding between this 190 to 195 range. Right now it's at like 196. Like if Micron actually takes a 10% dip from here, does Nvidia have to go back into the 180s? Or is memory going to be separate from a lot of the broader semiconductor streams? If Micron goes up 10% from here, does Nvidia get any move back up to the 210s? Like a lot of this stuff has been kind of not correlated with Nvidia, as it's been relatively stuck all year, whereas the memory names have been a lot more hostile. But now it feels like memory is the poster child for momentum. And by the way, we've been talking about July being the worst month for momentum on record. It absolutely is true. As we get into the end of July, this is what it looks like. Excluding the COVID crash, which again lasted very quickly, this has been the worst month for momentum on record. And March 2020 was bad, but it kind of recovered really quickly. Maybe August ends up getting a recovery relatively quickly, but many names 60 to 70% down from the top. We were talking about this yesterday. What is it going to take for Sandisk to get back to 2,300? Because it's like, okay, it was at 2,300, and one could argue it's still cheap at 2,300 if you look at the forward multiple. But if the forward multiple being super cheap 4 times, 5 times, 6 times isn't an argument anymore, because that's the argument you keep hearing. Well, the forward multiple is cheap, and I agree. The forward multiple is cheap. Theoretically, the forward multiple should be 8, 9, 10 times, which would theoretically get the stock to double as well. But if that's not an argument anymore, because no one cares about the forward multiple, they care about the sustainability of the overall cycle's growth when it comes to memory in general, or the broader semiconductor trade. Again, Jensen said yesterday, the semiconductor industry is going to have to 10x. Do you believe that story? Because that means Micron should be a lot higher than what it is today, and so should Nvidia, so should SK Hynix, so should TSM. Or is there going to be a cooling out of that broader spend in the industry? And I don't think anyone knows the answer for that. And I think the broader market is pretty freaking confused, no matter what good earnings results that we're actually getting here. And so that's what we got on memory. Hopefully we'll see if things change. August is technically worse than July, to be honest. If you look at July actually is the best month, is one of the best months for the year, not for momentum, but for the S&P 500. It's usually a very good month. August tends to be a sucky month, so does September, and then that's when you get October, November, December as the Santa Claus rally. Maybe this year's a little bit different. We do have the midterms coming up, so we're going to have to see. But something's got to change this sentiment, guys. Like something has to, and I don't know if it's going to be Warsh. I don't know if it's going to be Trump saying we have a ceasefire, but something SK Hynix missing by $1 billion. Yes, it's bad, but it shouldn't be the reason Kospi falls 6%. It shouldn't be an entire reason that a country's index falls 6% because they missed by $1 billion. Like it shouldn't be missing by $1 billion. But if they do, given the margins they have, the pricing power, the earnings potential, the growth, the lack of capacity coming online that they've reiterated over and over and over again, the importance that they have to the AI trade, you put all those qualitative elements against missing by a measly $1 billion. Like it should not be something that destroys the stock and then correspondingly hurts the entire memory trade in the US. But it is, because the sentiment around this AI trade is just becoming so god awful. And I think that's the broader issue that we are all experiencing. And then on top of that, you get what's going on with Trump and Iran, which let's get into right now. So we had a 4-day ceasefire. It wasn't an official ceasefire, but nonetheless, it was 4 days of not attacking. And then for some reason, Iran last night attacks a U.S. base in Jordan. I don't know why this was relatively unprovoked. Like the missiles were intercepted by U.S. bases, but as soon as this headline came out last night, oil started spiking up 4.35%. Oil was down at $77 yesterday on the close. It was down 17% in less than 48 hours. I mean, you started to see the S&P 500 get closer to 743. Like you were seeing some level of like movement and excitement of like, okay, maybe, you know, Pakistan, Egypt, Qatar, they were supposed to get involved in reviving the Memorandum of Understanding, which would get the U.S. and Iran to at least come to the table. Trump on Fox News yesterday said, I don't really want to have to, you know, bomb the bridges and the plants. So like you started putting the pieces together like, okay, if we can go a few more days without any strikes and they can get in a room with each other, we can get the negotiators to get back involved, maybe things will be okay. And then you get an attack from Iran yesterday. And then Trump, what does he say this morning? Well, Trump obviously is not going to let the attack not be responded to. Iran will be hit hard in response to the Jordan attack. And then oil spikes even higher again. Now we're at 85. I mean, it's obviously very annoying for the equity markets. It's incredibly annoying for the credit markets as the 10-year, which made some decent progress down yesterday. It was trading at 4.59. It was at 4.70 on Friday. That's a hell of a move when you look at the basis points that it was coming down on the 10-year itself. Now it's back at 4.62. So it's like you can't even catch a break because the market instantly reacts to the elevated oil prices and then shoots up the yield on the 10-year. And then on top of that, you have an FOMC decision today, which I don't think he's going to hike. Like, I really don't think he's going to hike rates today. But once again, those Fed FOMC participants are looking at the price of oil and they're saying, well, if this thing's not ending anytime soon, at some point we're going to have to hike, because if oil is going to continue to be the majority of the reason for inflation, which, you know, it has been for the past few months now, then we've got to do something to combat inflation. And, you know, hopefully it's not today, but if they end up hiking this year, that wouldn't be a good thing. Yes, I agree with a bunch of people in the chat right here saying that Iran is trying to mess with our elections. Iran is trying to keep gas prices up. Iran is trying to mess with the stock market. 100%. I think, you know, quite frankly, it is probably in Iran's interest to keep causing instability and pain to be able to mess with what's going on in the United States, because then if the U.S. responds, Iran can say, well, we have to respond again. But we did go 4 days without an attack, and Iran and Oman both agreed yesterday to the proposal. This is also why I was surprised by the attack from the Egyptians, the Qataris, and the Pakistanis around what it would take to revive the MOU. That doesn't mean they agreed to the MOU, but they agreed to the proposal to at least revive the MOU. And part of that revision was to make sure that no country were to put tolls going through the Strait of Hormuz, which would actually be, you know, really good for the United States and for Iran. And then they attacked last night. Iran has a micron short. They probably also, honestly, we need to figure out if Iran is shorting U.S. tech stocks, because, I mean, I feel like, it's like if you're going to go to war with a country and, you know, defend the Strait of Hormuz, and you know the Strait of Hormuz controls oil prices, which controls a lot of the economics of the country you're going to war with, why wouldn't you short their stock market and profit off that if you're going to be in that war? So who knows? Maybe they do have a short on Micron. But the point is, like, that 4-day ceasefire that made a lot of us think that things would have a chance to be okay, that's kind of out the window. And as a result of that, it's pretty annoying. Imagine that we don't have a real ceasefire until November, after the elections in both Israel and the United States have taken place. I mean, that's a good point, and that also begs the question: what the hell is going to happen with the elections? What the heck is going to happen with the midterms? I mean, at this point, dude, the midterms are not that far away, and I don't know what the Republican Party's messaging or Trump's messaging is on why you should vote for him into the midterms. Like, imagine the stock market falls 10% from here. You can't talk about 401ks. You can, I guess, talk about the labor market, although anecdotally, people don't feel like, you know, the economy is doing that well, especially if you don't own assets. The economy is not doing that well, right? That K-shaped economy. So then you have to go on this idea that I'm protecting the United States and protecting all citizens from a nuclear Iran, which maybe that's the midterm talking point. But I'm genuinely confused on what Trump thinks is going to be his pitch for the midterms. And so, you know, time will tell to see how this ends up playing out. But right now it's very, very confusing. And, you know, maybe this stuff ends before it gets that bad. But as of now, I don't think the market is going to be able to meaningfully reconcile this. The S&P 500 again down right here in the pre-market as soon as oil spiked up after those Trump comments on oil, 739.95. We've been oscillating around 735 to 745 We lose 730. I feel like it's lookout below, and 7,000s might be on the table. And if 7,000s are on the table, that means a lot of these stocks have lower to go. It's just that simple. And now I hope that doesn't happen. I think a rate hike would allow that to happen, which I don't think we're going to get today. But the most important thing I think we can say from, I think what we can say for if we are going to look to the bright side is that fundamentally the earnings from a lot of these AI stories are strong. I don't think anyone can really deny that, even if there's a couple misses here and there. But the bubble narrative, because of the backstopping, circular finance, yada, yada, is just out there. And it's making people doubt the sustainability and fundamental nature of these earnings. And when people start having that doubt, when that seed of an idea gets incepted into people's mind that it's all fake, and they actually see the stock prices reflect the negativity of that, and they see the weird sort of ways in which all of this is being financed. Even Google yesterday decided to start backstopping some more data center deals to the tune of about $50 billion. Like, you start seeing this stuff and you're like, okay, there's no money in the system for people to pay for this. Now, the money is there. It's in the ROI that comes from being able to get those data centers online, which the hyperscalers have already shown in their earnings, and we'll see Meta's and Microsoft's today to get that ROI. But in the meantime, there's a lot of shit that has to happen to get there. And I think the market is just calling BS on it. And then when you have Sam Altman say stuff like this around where AI is going, I don't know if it necessarily helps sentiment around the broader AI trade.
What we need to explain to the world. Number one, we are close to creating a genie that can grant any wish. Number two, we are going to make sure that our first wishes broadly benefit humanity, and that we kind of get the world to a place where a lot more people get to have a lot more wishes. And number three, the space of what you can wish for is incredibly big and creative, and it'll be quite exciting to like figure that out with real sort of human values and preferences. But I think there's a fourth thing too, which is exactly that. You start making these wishes, the computer grants them, and then you're like, I didn't think that was going to work.
Yeah.
What now? It's a weird feeling. What we need to explain to the world. Number one, we are close to creating a genie.
We are close to creating a genie that will grant every wish, and we are going to try to ask the genie to make sure we have safe AI. I mean, like, I don't know if that's the messaging we need right now to get people to feel very comfortable about what's happening with AI. But, that's what Sam Altman is saying. And once again, a lot of this stuff is narrative and perception. Part of the reason New York banned data centers is because the narrative and perception of AI is still so hated among so many people, even though, if you actually use these products, you're seeing the ROI and the importance of it every day. And, it's just, again, when we talk about sentiment, it's a really weird moment we're in, where numbers are good, but you've got this weird geopolitical crisis, which no one even knows why it started in the first place in March or why it's still going. Like, it just happened, and then boom, it's there, and it's like, all right, now we have to deal with this. And every time we have an attempt to navigate or deal with it, something comes up to make it flare up even further. That's in the background. And then you've got all these weird concerns around, where the AI trade is actually going, given the veracity and velocity of the sell-off that we've seen from the top. I mean, again, we talked about this yesterday. When a stock falls 50%, it has to double just for you to break even. Many of these names that are down 50%, I mean, Nebius has to get to 300 to break even if you bought it around that range, right? SanDisk 2,300. Micron has got to get to 1,200. Not necessarily a double from here, but still a hell of a move. And could that happen? Yeah, a couple 10% days. Like, you could see that compound and happen, because we saw that happen in April and May. But a lot of those April and May moves have been flushed out entirely. And so it makes you ask, in April and May, did those names go up because there was like something real, something fundamental, something people saw in the long term? Or was the magnitude of the move that happened in a very short period of time, which, if you were not in a lot of the semiconductor names like myself, you obviously felt a ton of FOMO. And I think a lot of people felt a ton of FOMO because many of us are in software, hyperscalers. We're not super levered up on the smallest photonics names. But, when the smallest photonics name goes from 25 to 250, which literally happened in 5 months this year when it comes to AAOI, and then it goes from 250 to 80, first of all, it's still up 4x year to date. But what is it going to take for it to go back from 80 to 250? Is that momentum and euphoria just gone completely? And was it only momentum and euphoria, or was it something real? And because I think people are questioning that, now you don't know if those stocks are going to get back there, which just leads to more selling because people are afraid. And then you have Sam Altman yesterday, who also said what it would take to lead to a compute oversupply. And, regardless of whether you agree with his analysis right here, the problem is even the idea of talking about oversupply when supply constraints have been the biggest bull case for earnings momentum is something I don't think the market necessarily wants to hear.
Forced to imagine a scenario where we are somehow oversupplied in compute in 2 years' time. What would be that story?
It does feel possible. If the models get so smart and so efficient that they can kind of do everything we need and, build every piece of software we want. And if the bounds of our attention are such that like they just cannot absorb more than what it turns out a fairly limited amount of compute can do, then we can get into oversupply. Also, if we don't drive the cost curve down because we hit some sort of scaling wall, we could also get into oversupply. Like the observation about uncapped demand implies a certain price.
Can you give your point? Forced to imagine.
He was supposed to say we can't get oversupplied because there's too much demand. That's what he was supposed to say. That's all he had to say. And he ended up giving some weird ass answer. And, it's not helping with the actual narrative that the market is looking for right now. All of this is to say, I think the broader AI story and the argument around what this industrial revolution, our generation's industrial revolution, is doing is intact, because the ROI, we are seeing it. I mean, it's very simple. It's not even my opinion or what I feel about or what my bias is. It's like I'm looking at Google's earnings. Like, okay, they're spending all this CapEx because of these results, and Meta and Microsoft hopefully will continue to prove the same. That's the ROI of the hyperscaler earnings is the quite literal only thing that I think determines if this is a bubble or not. It's not about how you feel. It's not about Jensen saying that. It's literally, are the biggest companies in the world that are spending all the money that are going to all these little companies that are part of this picks and shovels trade, are they going to keep spending it because they see the results? That's it. If you think the answer is no, then it's a bubble. If you think the answer is yes, then it's not a bubble. It's just that simple. I think the answer is yes, they're going to keep spending it because you are seeing the results, which is why the CFO of Google said we're going to continuously increase CapEx significantly in 2027. Meta is projected to announce $250 billion of CapEx. I don't know if they're going to actually announce it today, but that's what the sell side estimates are. And then Microsoft's expected to be in that same range for next year. Microsoft theoretically should announce it today because this is the start of their fiscal year in the end of Q2, but I don't know if they're actually going to announce it. So if that CapEx continues to be spent, that money from Microsoft, Amazon, Google, Meta, even the TSMs of the world are spending on CapEx. Intel's increasing their CapEx. Tesla's increasing their CapEx. All of that money is going to get dispersed across Broadcom and AMD and Nebius and CoreWeave and Marvell and your AEHRs, right? Your AAOIs, your Microns, your Bloom Energies. Like Bloom Energy, by the way, phenomenal earnings. We got to talk about them for a second. They said every new customer they're getting is basically a hyperscaler. And all those customers are looking at their technology versus natural gas because of how efficient it is when it comes to setting up data centers. So the most important thing about this is that if all these hyperscalers continue to want to spend that capital, it's going to go to all those companies, which is why their earnings will continue to do well. The question around what's happening in the broader scheme of the bubble is two things. A, what is the multiple you put on those companies? Very, very important. What is the multiple you put on this company? Because again, like as much as I think Bloom had a great earnings, do you want to pay 112 times earnings to buy Bloom? I don't know. I mean, the growth is good, 165% year over year, but do you pay that much of a premium to something that probably should have a long runway when it comes to fuel cell technology, because the data center build out is theoretically going on for the next decade. But is that an earnings multiple where you think there's a good risk reward? The stock is already down 50%, right? So maybe, the bottom is in. But the point is, what is the multiple you pay on it? And then number two, and more importantly, how much of the spending is rooted in OpenAI and Anthropic, and how much of their commitments could potentially crack a lot of the money that is going to go to a Bloom Energy or an Oracle or a Microsoft or a Micron, et cetera, that could get people to really start thinking, okay, the ROI is there, the CapEx is there, but the companies that were supposed to spend their money are not seeing the ROI at a smaller scale. And as a result, they can't afford to spend it, which means the money has to shift to another area. And in that meantime, as that money is shifting, or potentially that money is disappearing because maybe no one's going to take up OpenAI's commitments, that's where you start to see a bit more of an uglier reaction to how the trade is going on. So once again, I think you can have nuance here. I don't think it has to be black or white. I think you can acknowledge the hyperscalers will keep spending on CapEx to the tune of trillions because they have to if they want to keep up this type of growth. And if they're spending on CapEx, if they're diluting equity, if they're raising money in the debt markets, that money is going to get dispersed across all of these picks and shovels AI names. But once again, are the sustainability of the earnings on those picks and shovels names something the market wants to put a premium on, which is the answer to the question around why Micron's 5 times forward PE theoretically isn't as cheap as people think, even though conventionally, yes, it's obviously cheap, but the premium of that might be high if the market feels it's boom and bust. And then 2, what is the spending commitments from OpenAI and Anthropic? And I think the market's trying to resolve all of those questions, which is why SoFi goes down 7%. I don't think SoFi's earnings were bad. Unfortunately, I just think they're reporting at a time where there's massive, massive uncertainty right now in this market. I mean, SoFi is not going to go up 8% on a day where there's massive uncertainty, and get ready for Robinhood. I mean, I really freaking hope this stock goes up because I think it deserves it. And I think they're going to have the best quarter they've ever had. But if they crush the quarter and the stock goes down 10% because the market's like, yeah, we think trading volumes are going to go down because the semiconductor trade is dying out a little bit. So for the next 90 days, the market might just front run the fact that Robinhood's not going to have massive trading volumes. Like that could be a very easy reason for why the stock's down 10% after hours today. I mean, you can make up a ton of reasons for why Meta would be down 10% or Microsoft would be down 10%. Now, I think Microsoft and Meta, they're already down so much on the year, unlike Google that was up on the year, that there's probably a better chance that they get at least somewhat of a pump on good numbers. But who knows? Who knows at this point, given the nature of this macro? It's starting to feel like 2022. Honestly, the difference between 2026 and 2022 is that we have real earnings growth, number one, which is sort of like the core differentiating variable. And number 2, we don't have rate hikes. Unfortunately, we might get rate hikes this year, which would be very similar to 2022. And the earnings aren't being respected. So in 2022, there were no earnings growth. Like every company just had abysmal earnings. Palantir was barely growing. Meta was barely growing. Like Meta got to $1 trillion in 2022 off like nothing that would justify being $1 trillion, right? So the earnings were stupid. The multiples were stupid. Didn't make any sense. And obviously those names, as NVIDIA takes an ugly 1% candle right here, right before we get into the open. That was different. We actually do have earnings right now. Is there news on NVIDIA or is that just pre-market jitters? Because that one's getting hit right there. But in 2026, we do have the earnings. They're not getting respected. Now, in 2022, the earnings weren't getting respected because there weren't anything to respect. In 2026, the earnings aren't getting respected because the market is questioning the validity of the sustainability of those earnings, which does make it very similar, even though obviously you have record earnings, which are incredible. The other problem is it's a midterm year. So that is also very similar to 2022. And who knows if that midterm year kind of thesis ends up playing out, which would mean October we get some really, really good prices. But yeah, to your point, it's starting to feel a little bit like 2022. Any piece of good news getting rejected here. And, maybe it's just July. Maybe it's just this month. Maybe it's just something you have to deal with. But the worst month of momentum on record in the history of the stock market happening in a midterm year where really good earnings aren't being respected is weird. It also feels a bit overdone. It really does feel like, all right, enough is enough. And again, who am I to say enough is enough? If the market wants to go down, the market will continue to go down. But many of these names, 50 to 60% down, are they going to go 70 to 80%? And if they are their multiples going to compress to the point where they're trading at 1 times earnings, 5 times earnings? Like, what are these multiples going to look like in a year from now if these names continue to get hit? I kind of think at some point we're going to find that bottom. But if we don't, then the market's going to have to continue to see where this trade goes from here. We got about 30 seconds till the market opens. I don't know why NVIDIA got that red candle. Kind of feels like it's a pre-market thing. I don't see any news right there. Micron did get a green candle up about 1%. So Micron and NVIDIA kind of exchanged price action. Nebius earnings August 12th. That just came out. So in about a week, we'll see what happens to Nebius. Obviously, SoFi was today. We got Microsoft, Meta, and Hood today. We'll be covering that. SoFi down 7%. Hopefully, when the market opens, we can get something a little bit different. All right, here we go. Wednesday, July 29th. Thank you all for being here. The stock market is now open. All right, wake your ass up. Let's get into it. S&P 500 is down 0.2% on the day as that takes a hit, 739.22. That one gets hit. SK Hynix is down 1%. TSM is down about 1%. Micron goes green, 836 to 826. Actually takes a little bit of a $10 hit as soon as we get into the open, but nonetheless, it is green from last night. NVIDIA goes down. Again, not sure why NVIDIA took that hit. It was at 197 right before the market opened, but ultimately taking a little bit of a beating right there. T1 Energy, that's down about 2%. PayPal, that's up 0.5%. ASTS, that is up 2% on the day as well. Oracle, that's at 120. It was actually at 1 yesterday. Sofi, 1560. It had not seen 15 for the past month, which is a little weird again for it to get right into that range. But then again, it's not that weird given this macro is pretty ugly. And unfortunately, SoFi is experiencing it. 1547, that's down about 7.6%. TSM's down 1.3%. Bloom Energy, again, red candles because unfortunately, it's hard in this macro to go up. Now, again, their numbers absolutely incredible. Bloom demolished earnings, massive new hyperscaler contracts. It doesn't look like the runway for the trajectory of growth is slowing down, but that stock was up 15%. Now it's up 6%. And so the selling right here, it's either going to get bought or this market will continue to say if NVIDIA is not going higher and SK Hynix is not going higher, we're not going to let an energy play that trades at 100 times earnings also go higher, unfortunately, which is why I think that one's getting sold off. Intel right there, that's up about 0.32%. Snowflake, is that up on the day? Snowflake is up 5%. I don't see a headline on Snowflake, but it looks like there kind of has to be for that to be up about 5%. The SaaS names maybe continue to get some love. IGV, that's up on the day. How about Microsoft? Wow, Microsoft, red candle, down about 1% as soon as we open. Is Meta also taking that hit? Meta is also taking a hit, not 1%, but it opens red. SoFi, 9%? Feels a little aggressive. Just a little bit. Just a teeny tiny bit, dude. Goodness gracious. Fastly's had a very strong relative strength, I will say, in the midst of this semi sell-off. It is part semiconductor, part SaaS. It's not really semi, but it's in the semi trade because of CDNs. But the SaaS part of it, I think, is holding it up. Zeta also has done very well over the past couple of days. 2285, 2252, as that's up 2.86%. But again, I think the software names are up because the semis are down, and when the semis were up last week, Zeta was down. So there is a territory that's going on right there. SanDisk at least gets some love. Seagate had a good earnings as well. Seagate had a very, very good earnings. That was up 7.2%. Seagate actually, I thought, was part of the reason why the memory trade in general would be okay today, but then SK Hynix reported and the market didn't love it too much. Micron, that's up 2. SanDisk is up 1. So you're seeing a little bit of recovery on the memory trade. How about SK Hynix after missing their earnings? SK Hynix up about 1%. Now, SK Hynix was down 10 yesterday. So any level of recovery right here on Hynix would be good for Kospi as we get into the night. SpaceX, that's down 2 as that's taking a hit. Rocket Lab, that's down 1.2 as well. Adobe's actually getting some love. Okay, so maybe the SaaS names today, this would be the second day in a row, are getting, well, technically the third day in a row, are getting some deeper love. I just think we need to see moving averages get broken here on the SaaS names to the upside to see some real healthy momentum. How about ServiceNow, where we had at least 110 on that? ServiceNow, 110.82. It was at 112 yesterday. Amcor, which took a 25% hit yesterday, that's up 2.8%. Cheesecake Factory crushed it, had a great earnings, that's up 8%. The fact that the market is willing to take a restaurant stock up 8% and a memory stock that grew earnings 557% year over year, barely gets a percent move. A change just shows you where sentiment is right now, right? SK Hynix can barely move up 1% today. Cheesecake is up 8%. Now, Cheesecake is not growing like SK Hynix. They don't have the margins that SK Hynix has, but they're definitely safer theoretically in the eyes of the market. Same thing, Verizon, Coca-Cola, etc. That doesn't take away from Cheesecake Factory, but it goes to show that if SK Hynix was up 15% today, I don't know if Cheesecake Factory, Verizon, Coke, if those names would be getting the benefit that they're getting. But the market's obviously starting to feel that rotation to become a bit more intense. Rocket Lab right there, that's down about 1.2%. Google getting a little bit of love, up 30 cents today. The stock obviously took a pretty big hit on earnings. It's starting to recover a decent chunk of what it lost from earnings, 317 to 334. We will have the FOMC meeting. VG's up 7% because Trump said he's going to strike Iran, which is why those oil prices continue to climb up. We're at 84.22 on oil. That's up 6.2%. Nebesis, which took a pretty big hit yesterday when Micron fell. Nebius is down today, 166, down about 1.62. CoreWeave fell to 65 yesterday. CoreWeave at 66.34. And IREN, that one's basically flat on the day. So your neoclouds are going down. Your Amcors of the world are getting somewhat of a recovery after a pretty aggressive decline from 22% yesterday, 25%. They took the hit. SoFi still down 9%. I don't get it. I don't get why SoFi is NVIDIA getting a little recovery as well. I I don't know what they said that could get the market that upset about being 9%, or maybe the market's trying to front run the rate hike, which again, I don't think we're getting, but that would not be the best for SoFi. TSM, that's down 0.5%. Vertiv down 10. Again, Vertiv missed on a very small metric when it came to revenue. Not sure why it deserves a 10% drawdown, but it is. Micron losing a little bit of steam. 841 down to 829, but still up 1%. SanDisk officially goes red. For the past few days now, many of these names gapped up either at the market open or at around 11:30, and by the end of the day, they end up gapping right back down. So it's a little hard to trust the green candles once they come in, because the sellers get very excited on those gap ups, as those are the opportunities to short. And then you kind of see that end up playing out. Bloom's going to be interesting here if we can actually hold into the 180s, or if people come in and they take this one back down. But that's up 9%. They had the best earnings. I would say their earnings were probably better than Seagate's yesterday if we're looking at all the numbers. By the way, the reason Palantir was down yesterday, it was confusing why they were down in the midst of the SaaS sell-off. The reason is Cleveland Research put out a note saying commercial partners data came in below expectations in Q2 on increased competition fears. So there's a sell side firm that said, we think their Q2 commercial revenue will essentially be lower than expected because of increased competition. That's why that stock was down 9% yesterday. I think, Cleveland Research is not the most influential sell side firm in the world, but Palantir trades at an aggressive multiple. So if there's any, again, same thing with the memory trades, if there's any doubt in their numbers, if there's any misses, the market doesn't like it. So I think Palantir will have good earnings. I don't think they're going to miss on their numbers, but it obviously will react to these sell side reports because of the multiple they trade at. So as long as we get a strong earnings from them, I don't think the commercial revenue fears are going to be that intense. SpaceX down 1%. Rocket Lab down about 0.5%. Robinhood turns green. We're going to need some decent momentum for Robinhood to report earnings and for those earnings to be respected today. And I think the numbers are going to be relatively strong. I don't think the numbers are going to be bad. I just don't know if after hours, the macro will cooperate. Last quarter, the numbers weren't good, right? Like there were some numbers that were good, but the top line numbers were just not good for Hood. Like you can't be trading at the price earnings they traded and grow 15%. It's just not enough. So I think they're going to grow closer to 30% this quarter. The numbers should be fine. But we got to see how much the market is willing to give them a premium on. Corning, that one's getting some recovery. That was at 114 yesterday, now at 127, still down a lot from earnings. Reddit getting a nice move, 3.68%. If you bought the dip on the Google licensing deal going away last week at 165, you're doing well at 185 right here, as that news knocking out 10 billion in market cap probably didn't make a lot of sense. Apple right there still at 340, but Reddit getting that recovery. Lemonade, that we have earnings today for Lemonade. Whoa, 18%. Why did no one mention Lemonade? Did we have earnings? Lemonade, they came in line with EPS, negative 56 cents. They beat by 1% on revenue. Revenue's up 80% year over year. EPS is up 7% year over year. What the hell did they say for this thing to go down 18%? Oh my. Triple beat, right? Yeah. Well, they came in line with EPS, so I guess that wasn't a beat, but Nebius, are we continuing to sell off? Oh boy. Okay. Nebius is kind of the leader of the NeoCloud. So if Nebius goes down, you can expect CoreWeave to go down, which it is. Iren is going down. What about Wolf and APLD and all those guys? Wolf is down 4%. Well, that was all the NeoClouds all at once, actually. I don't even think that was just Nebius. All their candles look identical. They're literally all down 3.3%. Nebius a little bit worse at 4.6, but almost all of them are down 3.3. NVIDIA probably follows that price action. NVIDIA now down 1%. Not sure if there's a NeoCloud headline, although, speaking of NeoCloud headlines, there was some really bullish reports on H100 pricing and B200. So this is from the CEO of Compute Exchange, which is basically a marketplace that figures out the pricing for all of the rentals. Carmen Lee, she says, we've seen 15 to 30% price increases year to date across our A100, H100, H200, and B200 NeoCloud on-demand indices. Every day we ingest 170,000 observations from hundreds of data sources, and all of our data showing that the prices continue to go higher. So it's one of those things where it's like, in terms of the sort of core fundamentals of the NeoCloud business model, you need these prices to go up. And as you can see right here, the prices continue to go up, even with the dips in between the prices that they have throughout the year, because there are some peaks and valleys. Net, they are going higher, which is positive for the actual earnings, or at least the earnings expectations for the neoclouds. But I think the problem with the neocloud trade is the market. I think the market is thinking, okay, if AI is a bubble, then the neoclouds are like, the neoclouds are part of the house of cards that sustains that bubble. And if that house of cards is falling apart, the neoclouds are going to get destroyed, because at the end of the day, they're fancy REITs. Now, I think there's more to the nuance of what they're doing. You look at CoreWeave's backlog, you look at Nebius's holistic approach to how they're dealing with the software and trying to become a hyperscaler for compute in and of itself, not just the cloud that's selling the bare metals of the GPUs and renting them out. So there's nuances to that argument. But if the market perceives AI to be a bubble, the neoclouds, the memory names are seen as cyclical. The neoclouds are seen as just like fancy REITs that have a bunch of data centers in them. The photonics names are seen as things that no one even understands and that are overvalued. Like they're all the different nuances of the AI trade have their own bias to the downside if the market gets upset. And, on days like this, that's when the market expresses how upset they are. Lemonade down 20%. I am not sure what the Lemonade C-suite said, but whatever they said is not making the market happy. That's the other thing, as SBAM says right there in the chat. If Warsh actually hikes, which again, I do not think he will today, and I hope I'm right, but if he does, the neoclouds have a lot of debt, and they're continuously tapping the debt markets, and they don't have the balance sheets like a Meta, Microsoft, and Amazon, where theoretically interest rates don't really matter to the hyperscalers. It affects their cost of capital, but at the end of the day, those businesses produce so much cash that they don't really care. The neoclouds don't really produce that much cash. They are, that's why they need NVIDIA to backstop a lot of them, including CoreWeave and Nebius and Sharon AI, Shaz, that just got a backstop from NVIDIA. So if the cost of capital goes up, it uniquely can affect, how the neoclouds are ultimately financing all this stuff. And so, I think those arguments can be hit back with bull arguments, but at its core, those arguments have to be understood in the context of this price action, because I think that's what the market is digesting once it sees these names fall down. I don't think you could just say it's momentum drawing down. Like obviously momentum is drawing down, but at this point, every day 2 to 3% down, it's the market starting to question the fundamental thesis behind some of these names. Now, when the market does that, it usually creates one of the best buying opportunities for stocks that you have a long-term vision in, because if your thesis is correct that it's not a house of cards, it's not a bubble, and the market is wrong as Micron goes red, then you get some really irrational prices and great opportunities. But nonetheless, I don't think it's just momentum and margin calls and liquidations. I think the market's seriously starting to question some of the stuff, which it should. From time to time, the market should question it. It's just they are definitely questioning it and selling before they hear the answer to those questions. Next decade, that's up 5%. Ford, which had a good earnings, that's up 4.8% as well. Ford actually, did pretty well on the earnings, so can't even deny the market being excited to buy some Ford right here. UNH, that's down 0.5%. T1 Energy, that's down 1/3%. SoFi, again, it's tough, man. I don't know. It has not lost 15 today. Hopefully we can defend 15. Nebius has also not lost 160. So there are some key levels that they're trying to hold on right there. Why do you think Warsh will not hike? Well, the reason people are saying Warsh will hike is to establish credibility for the Fed, as in the Fed is, going to prove to the market that they're ready to tackle inflation. I don't think Warsh, and again, what the hell do I know? I'm not in his head, but I don't think he, based on everything I've heard from him, AMD, by the way, down another 1%, is concerned with the market's perception of his credibility by needing to enforce how much of a hawk he is. I think the Fed task forces thing that he's been pitching is what his reform is dedicated to doing, creating that credibility of how the market will be more rooted in making sure that we solve some of the sort of existential problems when it comes to finding fundamental truth around inflation. So I don't think he's going to hike to prove credibility. I don't think he will. But if he does, then, it's just not going to be fun. It is not going to be fun. GLW, that's up a little bit as that continues to go green, 1.9. See, GLW getting some love right here, up 2% on a pretty ugly day so far for most of the semiconductor stack. To me, it has nothing to do with GLW. To me, it's proving that at 114, things got stupid. And the market's like, okay, Like, it's still down a lot. It was at 170 2 weeks ago, but it doesn't need to go below 114. It doesn't need to go into the 100s. It doesn't need to go into the 90s. Like, there's still a fundamental story here that's very strong. We're going to compress the premium, compress the multiple, but we're going to stop the bleeding. Many of these names, I don't know if they found that GLW moment. I don't even know if 114 really is the bottom for GLW, but my assumption is, given the nature of the drawdown, that maybe that moment is in. You know, at Nebius, is it 150? Is it 120? As Nebius officially loses 160. Wow. 300 to 160. 159 right here. You know, is it 140, 130? Is it 159? Like, what is that range where the market says this is kind of dumb and we're going to stop some of the bleeding, even if we're going to take away a lot of the premium? Amazon goes below 230 as that one continues to get hit. ASTS, are we up right here? Okay, so the space names might be benefiting off of a Trump executive order yesterday that is forcing space companies to not have to comply with environmental regulations. So basically, the EPA is not going to be, it's not going to be stopping launches because of the carbon dioxide emissions that might be released as a result of a launch or something. So Blue Origin, Rocket Lab, SpaceX theoretically should be beneficiaries if the environmental protocols when it comes to launching things into space is not going to be in question. Now, all those names are down. ASTS is actually up today, maybe off the perception that you're going to have more launches, more satellites, more connectivity. That could be kind of the reason there, but the actual launch partners are down as Nebius continues its decline right here. I mean, so here's the question, right? What does it take for Nebius to get back into the 290 range? Like, I don't know at this point. Like, there's a very nice story long-term for Nebius, but that same momentum that got it there is just not here. And if it takes months or years to get back there, then I think if some people feel like, all right, it's going to take a year for this thing to get back, I'm just going to get out of it. That cascades and compounds the selling. I think we've been seeing that in a lot of different parts of the market, particularly on the memory names, obviously, as those have continued to get hit. SK Hynix still up 1.2%, Zeta's up 3.2%. Or people DCA and they say, okay, I bought it at 280. I'm going to buy it at 150 and lower my average. But now if that 150 goes down to 120, you know, that's where you get people that are just like, okay, this whole trade is done. And so you kind of need the bleeding to stop also just for sentiment to be okay. The problem is it's been a stair step down, right? Like March, it was 1 month and then we V-shaped. Tariffs, it was a few weeks, to be honest, then we V-shaped. This thing has been every other day. You have another 2-3% down on the most highly levered trades in the market. I think that's why people are more upset. Robinhood right there down 1%. Iren down 4% here. Fear and Greed's at 38. We are at fear. VIX is at 19. Again, the updates on oil this morning as Bitcoin goes green is that Trump is ready to strike again based on responding to the Jordan attack. Wow, Meta getting hit right there. Dude, if Meta and Microsoft tank today, goodbye to the S&P 500 because Google and Tesla took the S&P down 2% last week. If Meta and Microsoft actually go down, at the end of the day, Meta and Microsoft are big parts of the S&P. So, I mean, that's also why those earnings are going to be super important. NVIDIA barely holding on to 195 as we're seeing that one also get hit. ServiceNow is at 112, little reversal on Mr. ServiceNow. Uber's up, Netflix. Again, a lot of these safe plays that are not showing a ton of growth, but you definitely think will be around for a long time. Bloom was up 15, now it's up 4. Again, it's one of those things where if you own one of them, you kind of own all of them when it comes to sentiment. There's not that much divergence. I mean, there is divergence. Some are down way more than others, and some go up way faster than others, but the algos are all in the same trade. By the way, remember yesterday when I mentioned who is that fund that's out there that is super levered on the semis? I don't know if this fund is levered on the semis, but take a look at this book. Value Aligned Research Advisors. I mean, this is crazy. This was their 13F on March 30th. Bloom, Nebius, Seagate, CoreWeave, Lumentum, Western Digital, Celestica, Coherent, KLAX, Cypher, NVIDIA, Core Scientific, TeraWolf, Micron, SanDisk, Astera Labs, Riot, ASML, HUD 8. And by the way, not just small positions. We are talking about billion or the smallest position they have is worth $105 million. That's an ASML. Everything else is in the $200 to $400 million range. The three positions that they have $1 billion in are Nebius, Bloom, and Lumentum. Now, I don't know if they're on leverage. I don't know if they have puts. I don't know if they're protecting their portfolio. I don't know if they've sold a ton of calls. I don't even know. Maybe they sold the top in May. Maybe they got out of all of this stuff in May as this report came out on March 30th. But the point is, there's definitely some funds out there, and we need to keep an eye on Value Aligned Research Advisors, LLC, which sounds like long-term capital management, to be honest. If you know, you know. If you know, you know. Kind of sounds like LCTM. But the point is we need to keep an eye on them, because that is a fund where if they did not cover, if they did not protect themselves, if they didn't sell the top or at least take profits, I mean, they're down billions right now. And if they are down billions and they are down billions on margin, that's where you get the scenario where some shit blows up. And it doesn't mean that, the entire economy collapses or anything, but it does mean that like there is a fund that if they blow up, there's a lot of other funds that have to come in and help them recover from that, which just creates the compounding effect of selling in the short term, which could also be what we're seeing. Maybe that's just me coping and blaming a fund for all the sell-off, but it's not out of the question that theoretically could be happening. S&P 500 right there, down 0.5%, as that's now continuing to take a further hit on the broader S&P. Where is Mr. Microsoft? We are down a full 1% on Microsoft. SpaceX, which was actually the top of the market, this IPO, down 3.2%. Is Rocket Lab following? Rocket Lab is indeed following, down 2.8%. What do you think about Leopold now? So once again, I think people are dunking on Leopold a bit too aggressively because he is fully hedged in his portfolio. I mean, he disclosed billions and billions of dollars of notional value when it comes to puts. So we're going to find out how good this kid really is when his 13F comes out. Because look, at the end of the day, if he's holding on to his Nebius, his Bloom, his SanDisk, and he doesn't have a ton of protection, or he didn't exercise that protection, or he didn't sell any of those names, he's down a lot of money, like a lot. And those amazing returns that, he showed in the past 7 months, I mean, they would have to be down 30 to 40%. There's no way, he's not, even if his cost basis is so low, like you're still taking a pretty big hit from those highs. He's, obviously deep in the memory trade as well, but with Micron. But the other question here is, what if he sold? What if as DP said, what if he dumped at the top? I mean, what if we get his 13F and his Bloom Energy stake goes from 5% of the portfolio to 0.05%? What if at the 300 range, he realized that, like, what if the same excitement that allowed him to recognize in 2024 that this AI trade was going to be generational is the same knowledge that allowed him to realize things are too excited in May and April, and he took profits? It's hard for someone to do that. It's not easy to get the bottom and the top. But I think people are dunking on him way too early before finding out what he actually did. And if he actually, took substantial profits, then he played the trade really well. So we're going to have to see. But, the odds are, as Micron gets ready to go below 800, the odds are he did not sell the top because it's hard to sell the top. But we also don't know much about him. We don't know much of his personality. He doesn't do interviews. So, like, I don't know. Is the guy like narcissistic? Is he very humble? Does he, does he see a position that's up $3 billion and does he have risk management embedded in how he thinks about the world? Or is he just like, no, it's going to keep going up. This AI thing is not stopping for 10 years. Like, I don't know. I don't think any of us know. So we're going to have to find out in the next 40 days when we get those results. Tesla right there, 304, as Micron loses 800 completely. And honestly, Nebius has been following Micron more than anything when it comes to price action. So Nebius right there continuing to get hit, down about 8.5%. Is that was also down. Sam says Leopold is also hedged nicely with puts that are deep in the money. He was ready in case this happened. Yeah, that's the other thing. Is like the dude has a lot of puts. And I think that could help hedge the level of pain that could happen. But what is his Nebius price? Does anyone know? Because I know he owns like 5% of the company, but like when did he buy his Nebius? Because he doesn't have puts on Nebius, or maybe they weren't disclosed. But because I think he bought around this range on Nebius, right? It's like maybe a 120, but like he definitely didn't buy in the 200s, from my understanding. So that might be the position that's taken the biggest beating. And we just don't know how much of a position he has on there in regards to his cost basis. Google right there officially goes red. SoFi, are we still getting hit? I don't think he bought at 210. I think it was disclosed at 210 that he has a position. I think he bought like month before, but the disclosure was late for some like SEC special provision. I think. I could be dead wrong on this, but I think that's... If you bought at 210, yeah. If you bought 5% of the company at 210, stocks at 150, obviously he's feeling it. But actually, I'm not sure. SoFi loses 15. Loses $15. $14.95. We haven't seen those prices in 2 months, folks. Teradyne also had a really good earnings, 372 to 340, still up 6%. But that stock gets hit. Bloom going red was kind of predictable. As amazing as those earnings were, if NVIDIA is going to go down 2%, which NVIDIA officially goes down 2%, Bloom is not going to hold up on a day like that. All right, so NVIDIA taking the beating today, which is expected because of SK Hynix earnings, which I think was the catalyst for the entire sell-off today. Robinhood getting hit right here as well. So this is now where it gets ugly. I think we've experienced this literally 2 days in a row, 20 minutes after market open. We start to see a real flush out. NVIDIA did this on Monday, then recovered fully by the end of the day. Would not surprise me if they do that as well, but I think today is a bit more rooted in uncertainty given that FOMC. And the market could also be front running FOMC. Apple goes to all-time highs. Again, I do not think the market actually wants to pay the multiple they're paying for Apple right here. I think the market is just like, we know people are going to buy iPhones forever. We're afraid that people are not going to buy chips forever. And so we're going to buy Apple. But nonetheless, Apple tends to benefit from that level of uncertainty. Micron right there, 797, as that's getting hit. Why is SoFi down? I honestly don't know. Does anyone know? Like, I didn't listen to the earnings call. I saw the headline numbers. I don't know why it's down this much. I really think it's a fear of Warsh and what he's going to say, which is a rational fear. I think 10% is overdoing it, but nothing in the numbers, unless I'm missing like a big red flag. SK Hynix looks like it's about to go red. Should have warranted that big of a sell-off. Zeta right there, that's up 4%. Fear of a rate hike. Okay, so if it's just fear of a rate hike, you can't even do anything then, right? Like you got to look back. You got to sit back and be like, all right, if the market's afraid of a rate hike, there's nothing you could have done outside of sell before a potential rate hike. And then if the market doesn't hike, does SoFi pump 10%? You know, it's like some of that stuff you can't even worry about because you're like, well, at this point, it's not even about the company anymore. It's about external factors you have no control over. Wow, Vertiv 15% down as that continues to take a hit. Their guidance is counting for 2 hikes. Is that true? Do they update the guide to count for 2 hikes? I think I don't even think that was today. I think they announced that a while ago. I think you're right. Or did they announce that today? Because if they announced that today and they're raising their guidance on the probability of 2 hikes, which I don't think we're actually going to get 2 hikes, but let's say we do. I mean, the market should be happy that SoFi is raising guidance in a horrible environment. Yes, they said that today. It was today in the call. Okay, so then that feels irrational in my opinion. If Noto says, yeah, we think the Fed's going to rate hike twice, and we are increasing our revenue by 20 million, that means the fear of loan originations going down the gutter because of rate hikes is, I mean, unless they don't live up to the guide, but we know Noto tends to beat expectations every time. That would feel like 9% a little too much right there. Microsoft trying to recover, getting a little candle, but Microsoft's still down. Yes, the markets are pricing in 78% chance of at least one rate hike in 2026. Which here's the thing. If Trump actually comes out and says, okay, war's over and oil goes down to 65, I think that 78% goes down to like 20%. Because again, 75% of the increase, Salesforce right there up 2.3% of the day, on CPI, if you look at the past 2 months of numbers, is energy. It's not even like consumer electronics or memory or all this stuff, which is creating some inflation, obviously, because prices are going up, but it's energy. So if we actually get this Iran thing over with and oil comes down, which it was in June, which is kind of when the markets peaked, dude. When oil bottomed, the market peaked in mid-June. And as soon as oil started going up, and then, you had a bunch of different other catalysts, but like you did see a lot of market excitement when oil was getting in that 67 range. If that gets back there, I think the probability of a hike naturally would go down. But like Trump's not helping Warsh out here. Like he's got to throw Warsh a bone, and he's throwing him the hottest energy prices we've seen in a few years. And it's just not that easy for Warsh to convince the rest of these Fed members to, chill out and let the war resume without doing anything. I think that's why markets are so upset. Adobe 260. Okay, so the SaaS names are, where's Shopify? Dude, the SaaS names outside of Palantir, the SaaS names are at least getting some level of momentum right here. Oracle's down. That's more data center. CrowdStrike, this one's up a lot, so we got to give that one a break. And then Twilio, that one just hasn't had the best earnings this year, down 3%. But Zscaler, Intuit, Mongo, Atlassian, Salesforce, they're not up like crazy, but 2 to 3% across most of them. Palantir's also only down 0.3%. Means that people might be running to SaaS for a little bit of safety. ServiceNow, can we get some love? 113. Okay, we actually touched 114. Again, the deeper we go red on semis, I think the higher ServiceNow can. ServiceNow was at 140, Palantir was at 160, Salesforce was at 200 early June. In fact, I actually found the screenshot that I took on this. This is actually at the very end of May. Look at this screenshot. This is when I tweeted SaaS summer. This is May 31st. Look at these prices, bro. Forget Oracle because it's more data center stuff, but Oracle was at 238, Snowflake 257, Datadog 250, Adobe 266, Now 136, Palantir 160, IGV above 100, Shopify, which is actually higher than it is right now. Zeta was almost 25, Figma was 26, Microsoft was freaking 463. Now, SaaS summer hasn't necessarily played out, but we still have a month and a half left of summer. But I want to see those prices come back for me to really believe that the SaaS rotation is here. And if it does, I'd be happy. If not, then I would expect the semis to have the pendulum swing to them. It's just right now that hasn't really been happening. Intel still down about 1.2% here. CoreWeave, are we getting a little bounce? CoreWeave, very tiny bounce. 63 to 65. Are you still bullish on Zeta Mid? Yes, I am. Actually, I met Steinberg at the Palantir event. He was with Carp. Where it is? I took a selfie with our boy. There was Steinberg. And then, do you guys see the picture that he tweeted? He tweeted a picture of him and Carp. I think Zeta is going to crush earnings, dude. It's just, once again, it's not the most exciting story because it's marketing and advertising. So I don't know how much the market's going to be excited about this. But 50% revenue growth is something to be excited about, right? Right? 50% revenue growth? That's like, it's like, I mean, company's worth 4.2 billion. They're going to do almost 2 billion in revenue. Like, you would think, and profitable. You would think the market somewhat kind of cares, right? So it wouldn't surprise me to see it break out. My only fear is that, once again, is the market going to say, okay, this is advertising. If Meta goes down, if Reddit goes down, if, Trade Desk, if all these advertising names are getting hit, does small little Zeta get the benefit of the doubt here, even with them proving their numbers? And then also, is the macro environment in SaaS decent enough to have Zeta pop? But, every price target I've seen on Zeta is 35 to 40 bucks, and that would still make it relatively cheap compared to their growth. But again, a lot of this stuff is about narrative and how much the narrative wants to shift towards SaaS companies that the market thinks is not going to be commoditized by AI. Meta right there, still low at 590 as that's continued to take a hit. Shout out to Mr. Wealthmatica in the chat. This guy is the OG Zeta content creator, and he has educated so many of us. Dude, we got to get you on the channel, Wealth. I know you've been on Steve's channel. We got to find a time to get you on the channel, and we'll let you really explain it to us in depth. But he's been covering their story, for the past few years now. And hopefully this earnings just continues to prove that they are executing well. SK Hynix, all right, 3.4, starting to get a little bit more of a move. Oil just passed 85, so some of the memory stocks recovering. Oil continues to go higher. Nvidia still down 2%. Lemonade still down 22. Iran down 5. Amit, is the semi trade over? Let's ask the chat. What do people think? Is the semi trade over? My answer is no, but I think the goal of this channel is to explore every perspective. And I think for the past 2 days, we've explored multiple perspectives on what it would take for the market to perceive the semi trade to be over. Fundamentally, I can't say yes because I'm looking at the earnings. Like, I cannot say yes when I look at these earnings. Because for the trade to be over, it would imply that the earnings growth is over. And every single company that's reported, whether it's Bloom, ASML, TSM, etc. No, the answer is no. But could I understand why the market's afraid of the semiconductor trade? Yes. And I think we've talked very deeply about why that's happening. All right, I got to do a poll. I feel like it's like 60-40 no. It's just positioning. Dude, I don't think 60 to 70% drawdowns on semis is just positioning. Like, if we were down, 15 to 20%, okay, maybe it's market positioning. A company's getting chopped in half does not feel like positioning to me. That feels like retail's either liquidated, institutions lose faith in the story, or structurally something's broken in those companies. Now, again, I think the latter, structurally something broken in those companies, is not happening because of the earnings. I think the retail liquidations is massive. And I think institutions theoretically might say, hey, there's better opportunities for us to be in, and we've made our money here. Which, to me, when you put all those three together, that's more of a, all right, we're out of this thing. We made our money. We're leaving. But I don't think that's necessarily like, we need to be in defensives now. So I don't know. We got to see. And if it is positioning, it's one of those things where, okay, so they're going to get out of these names down 50%, and they're going to chase them back and position themselves higher when they go up 20%. Like, I feel like if you're an institution and you believe in Nebius, you believe in Nebius and you're going to hold on to the drawdown, or you stop believing in Nebius or Micron or whatever, and you go with it, back and forth. Microsoft right there still down. Netflix 72.58 as that one continues to take a hit. Sam says, if you strain the oil supply, you increase the price of logistics and disrupt the supply chain of chips. It all comes down to oil. I could not agree more, which is why, again, we really did well in June when oil came down. We were at 93 on Friday. We were at 77 yesterday. This thing's back at 85. Like, if we even had a chance to get this thing back into that $70 range, I feel like we would not be seeing Nebius and Micron take 7% hits, or Bloom barely able to hold on to their earnings, or Nvidia going down 3%. Like, I think a lot of this, unfortunately, has to do with oil. Oh boy, Treasury website, U.S. issues Iran-related sanctions. U.S. issues sanctions against 8 tankers, 10 entities in a new Iran-related action. Okay, so once again, is that the biggest deal in the world? No, because we've had sanctions on them for a long time. But the subtext of that is, we're not de-escalating. Right? Like, we're not de-escalating. If we're supposed to be relieving sanctions on these guys, not increasing sanctions if we want them to have any chance to sit down and have a conversation. And if people are like, oh, well, if we act tough with them, they'll like, really? If we act tough with them, they're going to negotiate? Really? Because it's been 4 freaking months. Acting tough has not done anything except inspire them to fight harder. And they're loving it because it's ruining our economy, ruining our freaking stock market, ruining sentiment. So I don't know if acting tough and putting more sanctions is going to get them to the table. But it will take oil prices up. Lemonade down 24% as that one continues to take a hit. Do you feel like buying anything right here? I agree a lot with what Jason said yesterday. I think everything feels like a falling knife right now. And if you buy a falling knife, you just have to be ready to let that knife continue to fall. I feel like having these stocks recover certain moving averages, having them put in at least 2 or 3 days of strength, ideally a week or 2 of strength, and then having more positive sentiment start to come into the broader markets, whether it's around rate hikes, whether it's around earnings, CapEx spend, oil prices, etc. Like, I feel like you need some of that stuff before you go YOLO buy the dip. Because once again, the YOLO buy the dip mentality worked when a V-shape happened every other day or every other week in anticipation of a structural bull market that was not slowing down. I mean, if price action is showing us anything, it's that that's not being respected. And that template or that framework for dips getting bought is going away. Now, if we get a macro catalyst, like Trump says the war is over tomorrow, do I think we get a massive V-shape? Yeah, I would hope. If we don't on that news, then I don't know what it's going to take. But the point is, everything feels like a falling knife. And it's, I think if you are buying the dip right here, it's the highest quality companies that you know you can hold for a very long time, which the hyperscalers come to mind. It's just unfortunately the hyperscalers, because they're negative free cash flow, you don't get to enjoy their sustainability in the short term because the market is afraid about it. Amcor right there, losing a lot of momentum as well. Because that's the other thing. I think people have been buying the dip for the past month in July. I mean, I've definitely bought the dip in July. And now you get to the point where you're like, okay, hold on. Before I even continue to allocate capital, maybe I should let some of these names prove to me that they deserve capital. If not, then if the prices are going to get really stupid, let them get really stupid. I mean, AMD was a dip from 480 after it touched 580. Now it's at 438. And at 480, just because it rebounded to 530, what didn't mean that was the V-shape. If anything, that hit support, got rejected, and then boom, or hit resistance, got rejected, and now you have a better opportunity. And is 438 fundamentally a good price for AMD? I don't know that company that well, but from my understanding, the price earnings on this has been pretty elevated all year. Yes, they've had good earnings, but they're obviously not growing at the level of NVIDIA. So the question becomes, could we get this below 400? Could we actually get AMD? Because S&P falls 3-4%, we are getting AMD below 400. Absolutely. If S&P falls down to 720, we are going to see that thing below 400. We're going to see NVIDIA in the 180s if that happens. And so then it begs the question, it's like, okay, could the S&P fall 3 or 4% from here as the S&P officially goes down about 1% on the day? It's like, well, I think I could think of a variety of catalysts that could get the S&P down 3 to 4% from here. And none of them have to do with earnings, even though earnings could create them. So that's why I'm like, well, I think you at least give it some time and prove that these names are worthy of your capital before getting super excited to buy the dip. Because obviously it hasn't worked out fully at the moment. Sofi still taking a big beating right there. AMD is still up massively, 100%, but it's only up massively for the people that bought it low. Like my AMD average is $208. And it's a small position, right? Now, if you have a massive position, your average is like, 150, like, yeah, it sucks to see it go from 580 to 430, but you don't care that much. If you're just entering the position at 437 in a falling knife pseudo bear market territory, it really begs the question, is this the time to be excited about it? Now, what if AMD rebounds to 550 and someone's like, okay, you missed your opportunity? It's like, okay, well, you missed your opportunity. It's like, you'd rather miss an opportunity than let that thing go back down to 300 and then bag hold, right? Like there's some level of risk mitigation you have to impose on your portfolio, especially when sentiment is just really bad. Someone might also say, well, sentiment really being bad is the buying opportunity. Sure, but sentiment's been bad for a month, and it's not been a buying opportunity. Like this entire month, any buys are red. So it's like, okay, at least give these names the ability to prove that they're worthy of being held and that sentiment structurally is changing, because right now every new headline we receive is just, just the opposite of that. Here's the update on the Trump-Iran situation from last night.
From the president that I guess we can't air, or at least maybe don't want to air.
We can summarize, but we're not going to air them. Yeah, that's right, David. So let's start with CENTCOM. They say that all of the Iranian ballistic missiles that were launched at American forces in Jordan last night were intercepted. But the fact that Tehran chose to escalate the war at a moment when President Trump is trying to pause it does show that an important dynamic may have changed here. It may be that Iran now wants the war to continue more than President Trump does. Why is that? Well, the flare-up of war puts pressure on the oil and stock markets and pressure on the president to agree to better terms than they might otherwise get. President Trump responded angrily with some rhetoric in a phone call this morning with Fox News saying, "We are going to beat the effing S out of them. We'll be hitting them hard. They are going to get a beating." So it appears.
Okay, I didn't know he said that. The summary I gave you was from the headlines that I saw the "will be hitting them hard" quote in response to the Jordan attack. I didn't know he said the first part. That also explains why oil ticked up. I mean, once again, does not feel like we're de-escalating.
As if U.S. military strikes on Iran will resume now after a multi-day pause. Separately, guys, Reuters reporting that Iran is buying as many as 400 shoulder-fired anti-aircraft missiles from China, an indication there that Tehran still has the supply line support to continue the fighting. So all of that leads to an open question, which is, what is the president's plan to end or win the war? What we still don't know, and a big open question here, is what was actually said in that meeting with Bibi Netanyahu here at the White House yesterday. We don't really have any indication of whether any strategic decisions were reached in that meeting, guys. Back over to you.
So we paused the bombing for a bit, but I would assume that beating the effing S out of them means that it's going to resume.
Yeah, I think that's how you have to read that, right? I mean, and what's more interesting about that, I think, is it might be the case that that's what Iran wants, right? I mean, Iran launching those ballistic missiles at U.S. forces last night, extraordinarily provocative, a real escalation by them. They seem to want to continue this fight, and you only want to continue the fight when you believe you have the upper hand in it. And why do they believe that? Well, I think they want to lock down their control of the Strait of Hormuz in any kind of post-war world. They want to put pressure on the oil market, on the stock market, in order to push the president to agree to some kind of Iranian control there that he hasn't been willing to agree to so far. We'll see whether the dynamic changes, though.
Meantime, this morning, Eamon, Reuters says that now the Houthis are considering fees for tankers transiting the Red Sea, and we continue to talk about the prospect of a second front in this war.
Yeah, the Houthi role here is fascinating, right? Because they're an Iranian-linked group. They're obviously, their stronghold is right near that strategic strait at the south end of the Red Sea, and they had sat out the beginning of the war. They decided to get in with this embargo on Saudi shipping through the south end of the Red Sea, and do they see an inflection point here where they can come in on the side of Iran and win some gains for themselves? Controlling these strategic bottlenecks is worth a lot of money for whoever does do it. It has been international shipping previous to now. If at some point you're a country that lives nearby and you can suddenly charge for access to that route, well, that's a huge boost to your treasury and a huge boost to your prospects going forward. So you can see why strategically the Houthis might say, hey, this is our moment.
Yeah, and to your point about the conversation, the readout, from the Israeli side, Prime Minister Netanyahu did tell the press after the meeting yesterday, it was one of the best conversations I've had with the President of the United States, our friend Donald Trump. Shared goals, right. A lot of talk about the fact that they're on the same page here.
Okay, if they're on the same page, yeah, we're gonna go back to attacking them. There was some hope yesterday that after that Netanyahu meeting, Trump would announce that they're trying to negotiate more seriously. And that's at least what the Egyptians, Qataris, and Pakistanis thought we might have a chance for. But if they're on the same page, we already know what page Israel's on. They obviously, want to continue the war. It's no secret. And if Trump is saying we're going to beat the effing S out of them, I don't know, man. Does that imply boots on the ground? I feel like that's the only logical thing that would imply 1490. Because the strikes at the end of the day, the strikes are not creating the type of damage that the Iranians are responding to that gives us an advantage. First of all, they're striking military bases, which once again, Iran is striking U.S. allied military bases in Jordan and Kuwait and Bahrain. So it's tit for tat. And then number two, there's 92 million people there, and Trump is making sure to not attack the actual, parts of the country where there's people there. And so I feel like the IRGC is just like, okay, we can keep taking the military tax, but until you put boots on the ground, until you actually go after Carg Island, until you hit our power plants, our bridges, until you do something that actually affects the country, not just the military parts of the country, that it's not going to get us to budge. Now, I don't think Trump necessarily wants to go further, because if he does, you're just going to have the entire international community looking at him like, dude, that's like, there are people that are dying that have nothing to do with this. And is there any way you can negotiate to have some level of an agreement? I think the international backlash that the United States would receive would be gigantic, which is why I think they've delayed going after the bridges and the power plants and all that shit. So he can keep saying we're going to beat the effing S out of them, but until they actually do it, which there's a reason for 4 months we've been hesitant to do it. I don't know if that's going to result in just striking military bases that would make Iran actually willing to negotiate, because it's been 4 months and they do not care to negotiate. 72 right there on Netflix as that one's continues getting hit. The Spy is getting a little green candle, but still down. Did SoFi really just hit a 52-week low? Oh my, that is lower than March. Goodness, dude. Yeah, March was 1493. We just hit 1488. That is lower than March here. And again, I think that has nothing to do with SoFi. It has everything to do, unfortunately, with this macro. The Fed speaking at 2:30, so it's going to take some time. It was 1460, was it? Are you sure? In March? If it was, then I guess we're pretty close. I thought it was 1490. Let me see. March. No, I have 1493. That was the wick down. I have 1493 on Webull. It doesn't matter whether it's 1490 or 1460. The point is, it's at those levels. Noto's on CNBC. Okay, let's go to Noto. Let's see what he's saying here. Let's pull this up.
A great net interest income margin, and we still think we can do that. We want to make sure we don't short ourselves in terms of investing in the long-term benefits of the business. But when rates go up, there is some level of uncertainty, and we just wanted to leave some cushion in case that happens. And our 60 cents in earnings per share is a very attractive growth rate relative to last year. The stock's also very attractive on a P multiple basis and a multiple of tangible book value. So we think it's a great time to buy the stock, but we're not going to be overly aggressive to try to get people to keep the momentum going as it relates to increasing guidance and driving momentum type of investors.
Yeah, I mean, you just said that you maintain the EPS guidance because of the investment you're making in the business. So how are you thinking about that reinvestment versus returns over the next year or so?
Yeah, no, great question. What we've said to the street for the last handful of years since we went public is that we're going to deliver a 30% incremental EBITDA margin and invest the rest back into the business. So that means for every $100 of incremental revenue that we drive year over year, we're going to drop 30 cents to the bottom line, have a 30% margin, which we have, and reinvest 70 cents back into the business. And that ultimately is going to allow us to compound growth in revenue for a lot longer time period. The margin profile of the business is going to be about 20 to 30% margins on a net income basis. And we will always be able to capture that margin. What we won't be able to capture is the top line growth And what we're seeing from our members and product appeal, we want to invest in that and drive it, as well as building future growth opportunities. So we want to maximize the top line. We're being prudent. We are dropping some to the bottom line, but we don't want to underinvest. So investors can expect us to drop 30% incremental EBITDA margins, and that will lead to a 30% net income margin over time.
Where are these people coming from? I mean, the 35% growth in members and I think more than 40% growth in products, where are you taking share from?
We're really taking it from the 5 largest banks and financial institutions in the country. We can see, fortunately, where the money is coming from an ACH standpoint, and it's really the largest banks in the country. You know, we grew members 1.1 million, which is 35%, as you mentioned, and then products 2.2 million members. I don't think the big banks even know who we are. We're really taking market share from them, but it's spread across 5 different banks. They have $1 trillion of deposits. We're up to $45 billion of deposits, which is great. Our balance sheet's up to $60 billion. But compared to their size and scale, they're not going to notice us taking share from them. So we're really benefiting from being below the radar screen, and it's made it really easy to go out and capture market share just by building great products.
And what is that? What does that look like? I mean, I'm sure this is your favorite question, but how would you say your value proposition is different right now that you're offering these clients versus the big banks?
Sure. The first thing is that you can do everything you want to do across spending, borrowing, saving, and protecting at SoFi. We give you the ability to do all those different things because our mission is to help you get your money right so that you can live the American dream. Savings only allows you to stay up with your expenses, but it doesn't allow you to get ahead. The only way Americans are going to be able to live the American dream is if they spend less than they make and invest the rest. And we're the only place on a digital platform that you can do all of the things that will result in you spending less than you make, invest the rest. We just launched something called SoFi Coach. I would encourage people to go on and check it out. It is an AI chatbot that actually helps you answer key questions. How much should I be spending? How much of a mortgage can I have? Where should I be investing? How do I reduce my expenses so I can invest more? Should I refinance my mortgage? Because we have all these products, we have a vast amount of data that no one else has. So not only are we giving you a one-stop shop, which no one does in the traditional banking world, we're also giving you the benefit of everyone's data across all those products to help you optimize your individual equation of spending less than you make and invest the rest.
I mean, the stock, though, you know, you mentioned the sell-off today on the earnings guidance, but it's down, I mean, more than 40% year to date. The banks have had a terrific year, and their business is booming right now. So what do you think the market is missing?
Yeah, I think ultimately what people have, I think struggled with for the fintech companies is that they're a little bit out of favor. They're high multiple stocks. When you're in an environment with great uncertainty, those multiples contract. And so we've seen a multiple contraction really across the sector. I think for the larger banks, their multiples were largely contracted, and they're benefiting from the incredible volatility in the marketplace. And so their trading businesses are doing incredibly well. And there's also a bunch of M&A activity. And so they have a different mix of revenue than we have and the broader fintech sector has. We're generally not market makers. We're generally not benefiting from volatility in markets being volatile. And we're not in the advisory M&A business. And so the financing tied to that is also not in our business. So it's really completely different revenue streams and therefore different drivers of valuation.
Anthony, finally, we're always, kind of poking around trying to determine if there are signs of stress among consumers. And I'm always fascinated by your cash advance product where you're able to borrow against your upcoming paycheck. Is that growing?
We don't have a cash advance product, Carl. That is a product that other fintechs offer. We do offer unsecured personal loans, which is growing tremendously. We had a record quarter in unsecured personal loans. It's a great product because what we're doing is we're going to prime customers that have accumulated some level of credit card debt, $20,000 to $30,000 of credit card debt. They're paying 25% on that credit card debt. And because they have a really good credit profile, prime credit profile, we're offering them 12% interest rate. It's half the cost of their debt. And so that product is really benefiting from the big banks not being in the unsecured personal loan business and really milking their credit card businesses. So it's a layup for us to be able to steal that market share. So we don't do the cash advance product. That's a lower end product, and we have a prime customer.
The other big news is the Notre Dame deal. So it's a big deal. You're going to be on the jerseys for the next few years with a patch. Is the marketing, is this about driving the student loan business for you, or how do you measure the payoff of these deals?
Yeah, we measure the payoff of these deals based on unaided brand awareness. When I joined the company in 2018, our unaided brand awareness was 2%. Our goal is to get our unaided brand awareness, which is essentially becoming a household brand name, a trusted household brand name. Our goal is to get to 30%. We hit a record this quarter at 10%. It's actually a Herculean task to increase your unaided brand awareness by 5x over that time period. We've been able to do it by partnering with really strong, credible household brand names and being associated with them. SoFi Stadium was the first big deal that we've done. We've partnered with the NBA. We're the official bank of the NBA. We're also the lead sponsor in the indoor golf simulator league called TGL. We have brand ambassadors like Wyndham Clark and Josh Allen and Justin Herbert, as well as golfers like Charlie Hull. And this deal with Notre Dame is about building our brand among a younger audience and where our members are, which is in sports. And we want people to know that we have an everything app that can help them get their money right. And having the presence on Notre Dame jerseys, which is an iconic brand and a great university, the home of champions, we believe will reach more and more unaided brand awareness. And it drives the entire business when people know about us and they want to look for a product that we may have.
All right, that's what you got from SoFi. Noto once again making the argument that the company continues to grow aggressively, not on the bottom line, but on the top line, members, products, revenue, etc. And maybe the street's just wanting a lot more. That was one of the questions one of the analysts asked. I got at the end of the call. I listened to, I think one question I got to listen to, which was one of the analysts said, do you guys think you're spending too much time focusing on that top line revenue growth versus monetizing those members? And Noto's argument was, look, this is the flywheel that keeps us going, and we're losing some profitability right now to get a lot of that LTV in the future. But the market does not care. Nabesis is, it's taking a beating. 9.5% down. 9.5% down. Micron down 3. Micron did touch 785. Now it's 796. It's not really defending 800 that well, but CoreWeave, Nebius, even your SaaS names, they're not really. Again, this is why I don't think there's a SaaS rotation. Like ServiceNow should be up 7-8% today. Shopify, Reddit, they should be absolutely exploding. And ServiceNow can barely get above 114. It's actually down from its high. Like, if the software names can't really make a move in this type of negative sentiment for semis, then I don't know. I'm questioning more of how much. And again, I want there to be a rotation. It would be nice. Because look, if the semis are going to go down anyway, you might as well put the money somewhere else, right? Like, it's not like I want the software names to go up because I want the semis to go down. But if the semis are going to go down, then instead of going to Verizon and Coca-Cola, can you go to Zeta and Reddit and Shopify and Palantir and ServiceNow? But it's barely even doing that. Microsoft trying to flip a little green all day or today. Iran down 8%. That's getting a hit. Yeah, Zeta's holding up, but again, it was almost at 23. Now it's at 22, 25. Like a lot of those moves are getting rejected when they get to key levels. Figma's another one. This one's at 24.39, basically flat on the day. This was at 27 a few weeks ago. Like, I want to see it break through those levels to be like, all right, software is back, which it did in the beginning of June. Just absolutely ripped until they got hit, and then the semis topped out in the month of June. CoreWeave now at 52-week lows. Oil still up 7. By the way, here's that clip of Trump. If you do not like hearing profanity, then you can mute for the next minute.
Got through. I also asked the president about those U.S. and Saudi airstrikes against Iran-backed Iraqi Shia militias overnight. He says those strikes were coordinated with the Iraqi government. He called these Iran-backed militias a cancer on the world and says he is considering additional warnings against Iranian proxies and their link to the Iranian regime. The president also talked about his meeting yesterday with Israeli Prime Minister Benjamin Netanyahu in the Oval Office. He says it was a great meeting, adding he understands now. It appears that the relationship between President Trump and the Israeli prime minister is strengthening. And again, the president called that meeting in the Oval great. In terms of possible talks with the Iranian regime, the president says we're going to let them keep talking. Remember, the Iranians came to President Trump after 13 straight days of U.S. bombing against Iran, asking to meet about the Strait of Hormuz and their broader nuclear ambitions. And those talks are taking place as we speak behind the scenes. And then this surprise attack launched against U.S. forces overnight. And again, President Trump telling Fox News, we are going to beat the effing S out of them, and that U.S. strikes will take place against Iran in response to the surprise attack overnight against U.S. forces in Jordan.
Okay, so that was Trump calling the reporter saying it, not saying it live. But that quote is actually interesting. He had a meeting with Netanyahu, and he tells Fox News, I understand now. What does that mean? I understand now. Because, I mean, what did Netanyahu possibly say that got him to understand what's happening with Iran? Like, did he not understand for the past 4 months what the U.S. got themselves into? Does that also mean, does that mean he understands he has to take over Cargo Island? Like, what exactly is he implying there? I think that level of uncertainty is also, you know, over the markets right now. It was a hint to invest in service now. I understand now. Yeah, 25% revenue growth. I understand now. I understand. Oh my gosh, dude. It's unbelievable. Well, look, if you have more software than semis, it's still a good day. It's still been a relatively good day and relatively good 2 weeks in comparison to the carnage in the semis. So even if it's not a full-on rotation, it is money that's moving to an extent. ELF down 2% as well. Obviously, the actual rotation, I feel like, has been defensives, financials, and healthcare. But software still got some of it. That's not the worst thing. Tesla, I think we're going to see this go below 300. I mean, all we need is another 0.5% down on the S&P. Tesla's below 300. I know it's holding on by a thread right there, but S&P goes down. We're going to see that happen. Amazon already below 230, 227. What do we think for Hood today, guys? Do we think this? I don't know, man. I'm just getting one of those feelings. It's the same feeling I had last time in Q1. It's the same feeling I had, which is like, I just don't know if the market's going to care. Now, in Q1, it was worse because they actually had a bad quarter. Q2, I think, is going to be exceptional. But, like, could we actually see this up 10, 15% up after hours, like, in this macro? I don't know, man. Like, I could see it happening, but I don't feel like I want to count on that being a thing. Sand is $17 away from losing 1,000. One thing to remember, though, is if Warsh doesn't hike and everyone's expecting a hike, maybe that's a buy the news. And maybe the market rallies on no hike. Maybe the market's so afraid of a hike that if he doesn't hike, we rally on the no hike. Maybe that, and then maybe Robinhood, Meta, and Microsoft have good earnings and they actually get an after hours rally. Like, maybe that's how it plays out. If not, then I feel like it's not going to be as fun. Doesn't matter. Look at Bloom numbers still red. Yeah, it's a good point. It's a good freaking point, man. 185 to 163 on Bloom. Like, the earnings didn't even happen. Bloom's actually lower than where it was yesterday before they reported earnings at 165. I think Hood's going to 70 this week. Oh my gosh, dude. That would be so bad. That would be so ugly. I mean, the thing is, if it goes to 80, which is only $9 away, the odds of it falling into that 78, 79 range, I mean, yeah, it's up there, dude. It would be almost exactly like what happened last quarter, unfortunately. What if he cuts? Dude, if Warsh cuts today, could you imagine? Now, what if the market tanks after he cuts? Like at that point, nothing is saving this thing, dude. That would actually be crazy. Yeah, surprise cut, not hike. Market down 5%. Oh my gosh, dude. You know, it's months like this where, once again, I think there's two layers of kind of navigating this. A, having a long-term portfolio and a trading portfolio. The reason I'm so big on that is because in your trading portfolio, which should be less than the notional size of your long-term portfolio, you can make some trades up and down. And like, even if your long-term portfolio is taking a hit, like there's a lot of good shorts today, a lot of good shorts, a lot of good opportunities to, you know, find little pockets of momentum that you can ride the wave on. And although it's not saving your longs, it is something that allows you to benefit from some of the market activity. Number two is reminding yourself why you have a long-term portfolio, which is that these names obviously are not going to go up every month, every day, even though that's what it felt like for 3 months. These are names to hold for the long term. Now, once you remember that these are names to hold for the long term, I think it does something really interesting. As fear and greed is now at 34 on fear, it makes you wonder, do you actually want to own these names for the long term? And I think that's also something this broader AI trade has forced people to ask themselves. Do I actually want to own Micron for the next 5 years? I mean, put in the chat, if you're in Micron, do you actually want to own it for the next 5 years? So do you want to own it from 2026 to 2031? I think that's actually a really interesting question if you polled a bunch of people that own memory or photonics, because I feel like the majority would say no. And that in and of itself is part of the reason why the trade is starting to take some weakness here, because like, who are the dip buyers if you don't want to own it for at least 5 years, which 5 years is not asking like a lifetime. 5 years is a minimum requirement for being a long-term investor, right? Like, I feel like 2 to 3 is not really long-term. 5 to 10 is like a baseline of like, hey, I want to own this company for the next 5 years. I believe in this company's vision for 5 years minimum. If the answer is no, then it's the answer is no for a lot of people. I'm pretty sure there's a bunch of South Koreans that probably don't want to own Samsung and SK Hynix for the next 5-10 years either. But if they want to own it for the next 5 months and are levered up to own it for the next 5 months, and the next 5 months doesn't go the way it's supposed to go, I mean, it leads to selling. It leads to selling. Depends on valuation. I get it. Yeah, but you're getting it at 5 times forward. Like, you're getting it at a relatively attractive price. I mean, how much cheaper does it need to be, right? It needs to go to 1 times forward. Like, you're getting it at a very cheap price in regards to their growth. But once again, the reason I think so many of you are saying no right here is because looking 5 years out, is Micron going to have 90% gross margins? I don't know. Maybe they do. Maybe AI demand is just that explosive, which I think it will still be that explosive, but that's good for NVIDIA. For Micron, it's a question of the supply coming online for a commodity, which at the end of the day, that's what HBM DRAM is. And so even if AI demand is explosive, they could grow top line revenue, but if they don't have the pricing power, because the supply means that they're not going to be able to charge these inflated prices, their EPS goes down, and then that PE doesn't look that exciting. Like, that's the entire problem with the memory trade. Now, granted, the same applies to a lot of different parts of the semi stack, but like the most boom and bust nature of that is in memory right here. It's less in GPUs, less in CPUs, less in stuff that actually takes intellectual property to create, less in, you know, cloud computing, which is going to be inevitable in the age of AI, and you need more of it. But a lot of that stuff is also not priced like a traditional commodity would be priced. Next decade, that's up 5% as oil continues to go on. Oh, Zitron's on? Oh, man. They brought Zitron on an ugly day. I think we are going to hear some more bearishness, folks. Let's pull this up. Zuckerberg did write a letter about AI yesterday as well. I think he's talking about that. Zuckerberg's Wall Street Journal piece was just like being optimistic about AI. So that was another letter that he put out yesterday.
Which models that do basically the same things as everyone else.
I'm not sure, you know, when you say breakout specifically their revenues, I'm curious as to what you mean by that. We do know that their core business seems to have been powered to a certain extent to a new level of profitability, though they're spending so much, you're not seeing that, as a result of AI being added so often to their various products. What would you look for when you say, I want AI broken out as its own revenue source?
Well, you are conflating the idea that their revenues continue to grow and they're also spending money on AI, and those two things being related. Meta has not said that. They have buried in 2 blogs that they've seen incremental single-digit percentage engagement increases, but they will not speak in direct dollar terms about what AI has done for them. but they've spent around 178, 180 billion dollars on capex, and that's not including this upcoming quarter that we're going to hear about this week.
Right. And they're obviously, we're very much focused on whether, in fact, they're going to even increase beyond. I think it's around 145 billion in expected capex overall. Do you not think Meta is a relevant player when it comes to the current frontier models and the LLMs?
No, I think that they're an also-ran. I think he threw $14 billion at scale for effectively no reason because he had no idea how to catch up, spending $50, $100 million for various AI engineers, and all we've got for it is a mid-tier LLM that does basically the same thing as everyone else. And now they're apparently working on something called Hatch, which is an open claw thing. It is an also-ran of an also-ran by an also-ran.
When it comes to this larger thesis that he's attacking in terms of the centralization of power, perhaps amongst two large companies or large models, namely OpenAI and Anthropic, I mean, do you believe that there is some credence to that view?
I mean, open source is better for everyone, and to be clear, open weights, meaning you can actually change the weights yourself. But remember, up until fairly recently, Meta was making, though they were primarily focused on open source, they only recently changed to closed source with Muse Spark. So it's unclear what it is that Mark Zuckerberg is arguing. Does he like open source? Does he like closed source? Or does he just not like Anthropic and OpenAI?
And what do you think the answer is?
I think that he hates anything he can't control, and apparently the New York Times is reporting that Anthropic may rent capacity from Meta anyway. I think Meta is just mad that they don't have access to a monopoly for something they perceive to be the future, even though I argue they're completely incorrect. And so Mark Zuckerberg is trying to muddy the water while also claiming that his LLMs are on the path to superintelligence when they're just boring niche software sold as general purpose software at a massive cost to just about everyone involved. And the only people that benefit are semiconductor companies.
We had a long discussion about that Times piece on Louisiana and Hyperion this morning. I think even critics of the company would acknowledge that they are wily, are they not?
I mean, they certainly know how to spend money, but remember, Mark Zuckerberg can't be fired. He can do whatever he wants. He's a mad king. And so he'll spend money in whatever way he wants. The incredible failure of ratings agencies to call these SPVs what they are, which is Meta-owned and Meta-related, so they need to be on the balance sheets. But because of this weird 20/80 split with the BlackRock SPV,
Yeah, that
and
was yesterday's deal. Yeah.
Yeah, they're able to keep them off their balance sheets. So really, this is just a company doing what the only thing it knows what to do, which is copy other people and spend a bunch of money.
Yeah, I mean, on the balance sheet question, though, to be fair, they are 4-year leases that conceivably they do have some liability. But I mean, from an accounting perspective, Ed, that is kind of, they're not breaking any laws at all, and they are going to spend an enormous amount to put all the stuff in that data center that you just mentioned as well yesterday. It's only $14 billion to actually build the powered shell. It's a lot more that Meta's going to spend in CapEx to outfit it.
Well, the Wall Street Journal reported I think about a month ago, that the Hyperion, specifically Ernst & Young, said that their whole accounting treatment of the VIE was actually a red flag, and yet they still let it go. I hate that we keep repeating these cycles. There are obvious problems here, and while it may be legal, the risk to investors is just the same. And it sucks that we're in this world where just because something is legal doesn't mean auditors don't push back and put a stop to it. And ultimately, investors will be the ones that suffer.
Have you always had a problem with Zuckerberg? I mean, I know you're pretty critical, I think, of Altman too. I'm just curious where the criticism came from, because you run a PR firm, don't you? So
primary research.
What do you do with it? Yeah.
So just to be clear about what I think about Zuckerberg, Meta's history is one of doing whatever they can to users to increase engagement. This is a company that historically, read Jeff Horwitz's Broken Code to learn more. This is a company that historically twists users in whatever path they need to increase engagement. The way they're doing AI is dangerous. It's chaotic. There are tons of stories about people being misled. There was an old man who fell to his death as a result of speaking to a Kylie Jenner LLM on Meta's platform. It's a reckless company run recklessly, and Mark Zuckerberg cannot be fired, so he'll do whatever he wants.
Okay. Ed, to be continued. Appreciate it. Thank you.
Thank you.
All right, up next, SK Hynix shares all over the.
Okay, that was Mr. Zitron on his disdain for Meta. Zucks did write that letter yesterday. S&P down about 0.86% right there, and that letter was about an optimistic future for AI. It wasn't that interesting in regards to what he was saying, but I think, he's trying to re-architect how people are thinking of AI, because there obviously is a PR problem when it comes to the general public's assumption around AI, but I don't know if Zuckerberg's the one who's gonna fix it. A couple different macro things we got right here. So this is interesting. In a report published today, JP Morgan said that the most levered ETFs in the Korean stock market have now been liquidated, and estimated that hedge funds deleveraging is also about 90% complete. So this would be important because obviously I think part of the decline this entire past 3 weeks has been a lot of liquidations from these single stock ETFs that have been levered. If that's potentially starting to come to an end, at least it's maybe some release. And then you have this stat that I thought was really interesting around retail. Call options on big tech hyperscalers now account for 55% of new option positions opened by retail investors over the past 20 days. This figure has surged 10 percentage points since the late March market bottom. This metric tracks newly initiated call option positions rather than total trading volume, highlighting the current directional bets of all retail investors. This is from the CBOE. So it's actually kind of interesting that retail is saying, all right, Google, Microsoft, Meta, Amazon, like these are the names that are beat up the most. This is where the majority of the call option buying is going to go to. Now, again, theoretically, I think directionally that makes sense given they're down the most and they're producing the most amount of capital and ROI from AI. But if that free cash flow negative sentiment continues to persist around the hyperscalers, then having an expiration date on those call options might not be the easiest to navigate. But Meta and Microsoft will hopefully give us some more updates on if actually buying leaps on these names makes sense. I mean, look, like a $700 leap on Meta feels relatively attractive given the risk reward, but what if it legit is stuck for another year? Which is the problem with options. Like you're putting yourself on an expiration date. What if Amazon is once again stuck until this CapEx cycle is done? Amazon 227 as that continues to go down. SoFi, I think we're above 14. We are at least above 14. Robinhood trying to make its way back up to the $90 range, $89.70 right there. $89.75, down about 3.2%. Rocket Lab still down 3%. Microsoft basically flat. SpaceX still down 3%. Yeah, PayPal leaps did not work out. PayPal leaps were one of the most popular trades back in summer of 23 because it looked super undervalued and looked like it should have the potential. But that one just did not hit. I think we have an update on Hood right here. Let me see if we can get some of this coverage. Actually, let's do chip stocks. And Hood. Hold on, let me pull this up. Okay, this should be what we're looking at.
250% jump in revenue growth. Our Christina Partsinevelos has more on the quarter, the memory trade, and what happened in South Korea overnight.
Yeah, SK Hynix, to your point, posted explosive growth, revenue and operating profit well over 250% year over year, but still came in short of the street's aggressive estimates. But like Micron, the company talked up 10 long-term deals, locking in customers, spoke to pricing improving. The one thing that may have nagged investors, management said the memory shortage can't last forever, and they're moving to expand supply. And so that is a constant worry for a lot of investors. Elsewhere within chips, the picture was mixed. Storage provider Seagate jumping 2% on a stronger guidance. Semi-equipment maker KLA, though, moving opposite direction, down about 8% as investors really worried about pricing power for this semi-cap name. Auto chipmaker NXP fell on cautious comments about customer inventory, especially when others, like competitors TXN, were more bullish. And then Global Foundries moving a little bit lower after a deal giving the Commerce Department roughly a 1% stake, shares down 3%. But overall, what happened is that yesterday we actually saw some signs of life in the chip trade. Trading actually opened with heavy selling within the first 45 minutes of the day, but by the afternoon, we saw the strongest intraday buying of tech since the unwind in mid-June, which might be a hint the selling may be nearing its end. This, according to UBS. But now on the flip side, Vanda Research saying retail selling was overwhelmingly in memory yesterday. Micron, SanDisk, Seagate, Western Digital made up 88% of the net selling within the retail trade, while up memory ETFs like DRAM were up as a defensive play. So people are selling individuals and getting into the ETFs. Still, the anxiety persists, whether the memory boom is sustainable, circular looking financing deals involving NVIDIA and AMD, competition from China, and just overall very crowded positioning in many of these chip trades. The real risk, though, is a loss of faith in the AI spending story itself, which would force a rethink of valuations across the board. David?
Oh, yes, it would, if in fact that actually happened. Christina, thank you. Up next, what the options market is signaling about.
Okay, so obviously the chip trade right there from retail is, I mean, and that goes to what JP Morgan said, right? Which is that there's more some forced selling that is happening within these levered ETFs. And that's creating more pain. Again, if that is over with, which it's going to take some time to figure out if that's actually over with, but eventually if that could, be resolved, I think there's a better chance for maybe this thing to not be as aggressive. If retail is paper handing memory the most, it does mean that the selling is getting to a point where it's that intense for the biggest trade of the year to start feeling some weakness from the biggest set of shareholders, which were ultimately retail, which honestly were earlier to the memory trade before everybody else. So then it brings up the question, what is going to get that sentiment to come back? SK Hynix did say on their call last night, again, that, it's not going to last forever, that shortage, which I think everybody knows that, but the reality of hearing it definitely questions how people think about the long-term growth of it. Here's the update on Robinhood and what the options market is implying on that as well.
Week for crypto and potentially very telling for prediction markets, as it will include the first half of the World Cup. The stock's down 20% this year after getting to break even just a few weeks ago. Options traders expect a very big move after earnings, about 9%, which is basically the Robinhood standard of the past year. The stock hasn't made a high since September, but right now, more calls are trading than puts, and the most popular contract by volume is the 120 strike call expiring August 21st that needs a monster 33% rally to pay off. The biggest trade of the morning was someone buying almost 4,000 of those calls, selling the same number of 130 strikes behind it, creating a $250,000 bullish call spread. And meanwhile, the most popular contract to sell today is the Friday 90 strike put, which is right at the money, meaning options traders look very confident Robinhood will put in a low here. And helping the stock is its dwindling relationship to crypto. The correlation between Hood and Bitcoin was near 1 for most of last year, but the past 30 days, guys, is now close to 0.
Oliver, thanks for that important day here.
That is somewhat encouraging. The option market seeing this as a floor, this $90 range. But is that going to be enough today? Is the deeper question. Sounds like a bull trap. It might be. It might be. SpaceX right there down 2%. Netflix flat. Robinhood back to 90. Let's see if we can hold on to it. APLD down 10. Okay, so the NeoCloud sell-off continuing to worsen. Nebius right there down 9. That is also creating some more pain. Amazon down 1. Meta right there down about 0.25. Micron's still getting hit down 4. It's not at the absolute lows today, but still somewhat down. Where is oil? Oil is 85.30. Highs of the day, folks. 7.6. 7.6% up is what you've got right now. Having said that, again, it kind of does feel like a lot of the selling has been flushed out early in the morning, but again, we just have no idea. There's a green candle on NVIDIA. That's probably helping a lot of these names right now. If NVIDIA can actually get above 193, 194, I think you might see the rest of the market cooperate. Adobe, that's up 5. Adobe having a great day. ServiceNow still up 2. Figma's up 0.5%. Zeta's back up to 1.5%. SMH, it lost 535 yesterday, down another 3% right here. As SMH continues to kind of hold on at least into the 500s. 33 on fear and greed. 33 on fear and greed. What are your thoughts on Oracle? I think, so the headline that came out on Friday on Oracle was that the Paramount acquisition of Warner Brothers is going to be delayed. And I think that's because as Oracle stock has gone down, the banks are afraid of the collateral that Ellison has used, aka Oracle stock, to do the trillions of dollars of stuff he's trying to do. Data centers, buy up media entities, etc. I just think they're over leveraged. I don't think the over leverage matters as a consequence of like the entire thesis being disrupted, because they've been over leveraged for the past year and a half. It's more so a question of, can they get the spending commitments that were promised to them via the RPO in order to resolve that leverage? And I think the market is just questioning, which is why their CDSs have, exploded. So, they've been over leveraged for a while. The market has not cared, but I think if the market starts to doubt OpenAI, they will start to care. Nebius, did we stop at 190 or 150? 151 we stopped at. 154 right here. Let's do another poll right here. By the way, 75% of you said the semis trade is not over. Let's do a poll on if we think we're getting a rate hike. Again, I think the answer is no, but it's also like, man, what if? What freaking if they do? Do we get a hike today? I will be live at like 2:15 today. So 15 minutes before. 2:30 p.m. Eastern is when we get the announcement. Or 2 p.m. is when we get the announcement. 2:30 is when Warsh starts talking. If we do, I think we're just going to have to figure out how to navigate it. Let's get a preview on Microsoft, as that's going to be important. We talked about Microsoft and Meta a lot yesterday. I think at this point, it's a question of Azure for Microsoft, Copilot numbers, their software business, the seats turning into more usage-based pricing around consumption. All that stuff matters. And for Meta, it's Meta Compute. Like, that's literally the only story I think the market is really going to care about.
Investors are going to be watching 3 main things. You have Azure growth, AI revenue, and then CapEx, capital expenditures. That forecast for spending, in particular, the Azure cloud business for Microsoft, does really remain the best barometer of enterprise demand out there. Analysts want to see that AI is actually helping to accelerate cloud growth, not just shifting some of those existing workloads. Capacity constraints, another big thing to watch on the demand side, also known as a backlog. Microsoft has acknowledged that AI demand was, at least at one point, exceeding capacity. Investors do want to know if data centers are coming online fast enough. And there has been a lot of fatigue, guys, around some of the AI spending, especially after Google raised its CapEx outlook last week. Investors are growing more sensitive to just how much these tech giants are spending in the AI race. Microsoft has already guided to about $190 billion in investment this fiscal year. Cowen and Evercore among those out there, saying that any further increase could pressure the stock today. Investors do also want to see how AI is really showing up in the numbers for the quarter, and then answer the outgoing question. What about returns? They want to see real returns. If that could actually show up in products like Copilot, like 365, those are becoming meaningful revenue drivers. And finally, any sort of commentary from the CEO, Satya Nadella, on the call. Microsoft has been diversifying away from OpenAI, one of its biggest partners. Nadella has waded into this open source debate too, and he has shifted his message in recent months. He's focused a lot more on delivering AI at a lower cost. Microsoft shares for the year, down about 15%, guys. Back to you.
Yeah, I mean, you do have to wonder, like, whether how the market's feeling about Microsoft. Is it an AI stock or is it a software stock? And that relates because, I mean, they had a good quarter and a really poor sell-off after earnings in the last few quarters, right?
It seems like the narrative has been dominated around AI. Even if the quarter looks good and some of the enterprise products look good, there has to be some sort of return on that investment. And I think that Microsoft has enough avenues within the company, within that entire corporate umbrella. I mean, it's sprawling to show some evidence that that is actually paying off, whether it's Copilot and some of these chatbots or the Office suite. They really do have a grip on enterprise. If they're able to turn that story into, yes, the spending is paying off, I think that's where it comes full circle. It's not just spending. It's, hey, are we starting to even see breadcrumbs of this paying off? And that's the challenge for all of these executives, is to sort of show the trust me story, the demand is there, and explain that to investors. And if they're able to toe that line, it may be starting to pay off, but we'll see if they're able to.
Well, they're also spending a lot, and the
are.
market's mood has changed around CapEx. Thank you, Kate. Kate Rooney.
Thanks,
Similar story here for Meta when it comes to CapEx and showing proof. Let's get to Julia Boorstin on what to expect there. Julia.
Well, Sarah, investors are looking for evidence that Meta's AI investments, as much as $145 billion in CapEx this year, will pay off. Now, this quarter, revenue growth is expected to slow to a pace of nearly 27%. That's down from 33% revenue growth in the first quarter, while earnings per share are expected to grow just 1% from the year-ago quarter. Now, another key metric that will reveal whether AI is making Meta's products stickier: daily active people who use Meta's apps. That number declined sequentially in the first quarter for the first time ever, which Meta attributed to internet disruptions in Iran, as well as WhatsApp restrictions. So now the question is whether the teen ban starting to roll out across Europe, which is Meta's second largest region by revenue behind only the US, will hurt user numbers and Meta's ability to acquire lifelong users. Plus, Meta's also fighting lawsuits across the country here about the addictive nature of its design for teens. With Meta shares down 12% since its last earnings, analysts are bullish. 90% have a buy rating, the rest have holds, no sell ratings. There is one area driving optimism from analysts, which is Meta's potential move to sell AI compute and build out a cloud business. Loop Capital, with a buy rating on the stock, writing today, quote, "We think the Meta compute opportunity is real. The company's strategy to externally monetize computing infrastructure will be a question for management." Now, ahead of earnings, Mark Zuckerberg has come out swinging against Anthropic and OpenAI's what he calls centralization of AI power in the Wall Street Journal and New York Times. Zuckerberg saying he supports more openness. So we're going to have to see how he ties this into his strategy around AI. Carl?
It's going to be a big night. Thank you, Julia, and thanks to Kate Rooney.
Meta and Microsoft, they will determine what ends up happening to the market today. You guys in the chat have said 80% we will not get a rate hike. I agree with the majority of people, and hopefully that's the case. And who knows, maybe it really is a buy the news if we don't get a rate hike, if everyone's so afraid that we are going to get one, even if it's not like something substantial. But definitely some of these names, Bloom now down 2%, get some relief in the midst of the market not being that afraid anymore of a hike. But at 2 p.m., we will know. Pound right there, 125, getting a little bit more green. Seagate, that was up 8%. Now it's only up 2%. Enphase up 1%. Enphase actually had a relatively okay earnings, but that stock also down or barely up. And you've got UPS, that's down 0.5%. Sherwin-Williams down 3.6%. Procter & Gamble actually had a decent earnings. That's even down 2.5% after those earnings as well. Yeah, S&P getting a little bit of a tick up. 733 to 735. Is SoFi still down? SoFi, it was down a lot more. It's down 10. Now it's down 8.6. Nebius still about $2 higher. Robinhood trying to hold on to 90. Let's actually pull this up right there. They're talking about what the case would be for a rate hike. I think it's worth at least hearing why a rate hike could happen. I mean, the case would be inflation goes higher. It's just if inflation's mainly energy, then energy it could come down theoretically, which means it's not going to go higher. If it's this whole credibility thing, I feel like that case is a lot lower.
Turnaround from where we were about 6 months ago. When you look at the regional manufacturing and services PMI data, it's very clear that there's an uptick in wages that you can detect. And keep in mind, the unemployment rate has been falling, right? So that would argue for a somewhat tighter labor market conditions.
Yeah, I mean, you were real out front saying that you think that they'd go in July. I noted the Citadel note today as well, and I do think there's a case there. The case against it, Neil, is do they have to, right? Because core inflation is cooling, and a lot of what you mentioned are external factors like oil, like tariffs. Like I don't think that Warsh is necessarily making the distinction, but there's also a case that they don't have to go.
Well, I mean, I think, to quote Governor Waller, you can't just stare at it with a vexing gaze. But, look at it this way, Sarah. Inflation has been elevated for some time and prices of commodities are surging. I find these trends particularly vexing at a time when global demand growth has slowed. So, you know who that was? That was Kevin Warsh back in 2008. He said that. And the interesting distinction today is that the labor market in the U.S. is in a much stronger place now than it was back then, and he was calling for hikes back then. So, look, and I would also push back a little bit against what you said on core inflation. We had one good month, pretty narrow in scope. The first 5 months, core PCE inflation ran twice the Fed's target. It ran over 4% at an annual rate. So, to me, look, I mean, I think there are risks to the outlook. I've been saying that. I mean, this isn't necessarily my reaction function, but when you go through what the hawks have been saying, they probably should shoot for the moon right now. I think, again, with what's going on with oil, right? It's sort of a fool me once, shame on you, fool me twice, shame on me. Inventories have been drawn down, and that's putting additional upward pressure on oil this morning. That's going to have implications for inflation expectations, which the Fed is clearly concerned about, at least with respect to households.
And the other argument that you didn't note that I think supports your argument is on credibility, not just independence of the Fed against politics, but credibility on inflation fighting and sort of showing the market that, look, we don't tee off of market expectations. We tee off of what's going on with inflation, and that inflation is a priority. And if you read the language and the comments from Fed Chairman Warsh over the last few public times he's spoken, I mean, it's been all about this Fed is serious about price stability.
Yeah, I mean, I think there are two sort of camps with that comment on price stability. I mean, the one is sort of this innocuous, like, well, that's always what the Fed believes, is that they believe in price stability. I think the other side of this is was that a policy signal? I mean, let's keep in mind that Chairman Warsh's first meeting, the press conference in June, that was the most hawkish press conference in the history of press conferences. Okay, I mean, if you look at as measured by the increase in two-year yields after that meeting. So, look, I mean, there's a lot of people that project their own views onto what he is. I mean, he's been very circumspect around his own views. But I would just say, if you look at the case the hawks have been making, it isn't about credibility or anything like that. This is just about reading the data. Inflation has been too high. Labor market conditions are stable, and the outlook for inflation is probably a little bit worse at the margin than better, given recent events. So if you think you're going to hike later this year, twice potentially, you might as well just push for one now. It's not that dissimilar from what happened in September of 2024, where it was pretty obvious the Fed was about to cut more than once. So you might as well just do a larger upfront move. I think the same sort of rationale applies today.
Hey, finally, Neil, FT's got a piece up about the BEA and this change to PCE methodology. Is that going to be material? I mean, you think it's more about getting better data versus, I don't know, trying to frame it better, more constructively for the?
No, I don't think that there's I would push back against the idea that there's a political dimension to it. I mean, some of the provisions go in different directions. I mean, the legal services change probably puts upward pressure on inflation. So that, to me, this is about better data methods. But in the broad scheme of things, it probably cuts core inflation by up to 0.2 over the last 12 months. I mean, that doesn't materially change what's going on. I mean, keep in mind that core inflation over the last year has been running almost 3.5%. So a couple of tenths off that doesn't really change the discussion, in my opinion.
All right, folks, we are going to see what ends up happening later today here.
Good stuff.
In particular around this FOMC decision. I mean, the argument he made around 2024 when we kind of did have a surprise cut in 2024, and the market knew we were going to get a cut. So it was right before the election, and we cut, even though people thought it was supposed to happen in November, ended up happening in September. If that's the argument he's making around the hike, it would be kind of interesting if he thinks a hike is inevitable and we might as well get it over with. Having said that, I think in this macro, given oil is one of the primary reasons for it, and just given, I think Trump's head would explode if we hike. Because if Trump thought we were really going to hike, even going into the print, you would think he would de-escalate a little bit because he knows that oil prices make it really hard for the Fed not to hike. But if Trump doesn't care anymore, and the Fed's like, all right, if you don't care anymore about making our job easier, then we're going to have to do what we have to do, which means we're going to have to hike. That could be the surprise that we have to deal with today, even though I really just don't think it's going to happen. As oil hits 85 right here, continuing to gap up 7.6% on the day. All right, I'll be back on the FOMC stream. I will be in New York, so I will be in a WeWork streaming it. So I will not be in the regular studio, but we'll be live at 2:15. We will try to get through all these results and see how the market ultimately is interpreting it. Again, I don't think we're going to get a hike, but if we do, we just have to be ready for it. Maybe if we don't get a hike, the market's excited because we're so scared of getting a hike. But regardless of the hike, Meta, Microsoft after the bell, Robinhood, those are going to be the Qualcomm. You got a bunch of companies reporting today. Those are going to be kind of what determines at least the trajectory for the rest of this market. We're seeing a very, very, very little bounce. I mean, the slightest of bounces across some of these names. They're not at their intraday lows, but they're still down a lot. AMD 428 to 430. Again, very small bounce, but still close to it. So really, I think this decision will determine everything. Also, the price action today is not irregular. Usually before the FOMC, we tend to be red because everyone's just afraid of what's going to happen. It's just now that a hike is on the table, it really makes the fears a bit more intense. And so we'll probably get some clarity at around 2 p.m. All right, word of the day. Let's do word of the day. Kairosis seems to be the word of the day. The recognition that a decisive moment has arrived, a point at which an action must be taken because the timing is uniquely right. The company spent years building quietly, but its kairosis came when AI demand suddenly accelerated. The word of the day is depression. Oh my gosh. All right. Well, a decisive moment has arrived today for the Fed, and I'll be live in a few hours to see what decision that they end up making. All right. Thank you, everybody, for being here. I'll be back in a few hours. 2:15, we'll be live. 2:15 p.m. Eastern, and we will see what the Fed says. Right after that stream, we'll get into Robinhood earnings with Meta and Microsoft, and we'll keep going from there. Thank you, everybody. Appreciate it. I'll see you guys in a few hours. Bye, everybody. Have a good one.